Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the night deepens? A cozy corner where the weight of the day is finally lifting? Wherever you are, you're exactly where you need to be. Tonight we're going to explore one of the most dramatic financial crises in American history, the Panic of 1907, and the remarkable story of one man who stood between the nation and complete economic collapse. We'll discover how a single private citizen, without government authority or legal power, orchestrated the rescue of an entire financial system through force of will, personal fortune, and strategic brilliance. We'll meet the personalities involved, walk the corridors of power during those frantic autumn weeks, and slowly, carefully, understand how the world's most powerful economy teetered on the edge of catastrophe and somehow pulled back. But don't worry. This isn't going to be a frantic recounting of financial chaos or a sensational exploration of crisis. Instead, we'll move slowly and thoughtfully through the years leading up to 1907, through the panic itself, and through the aftermath that changed American finance forever. We'll take our time with the details, the personalities, the quiet moments of decision that shaped history. By the end, I think you'll find that this crisis was not just about banks failing or markets crashing, but about leadership, about trust, about how financial systems depend on confidence as much as capital. If you enjoy these calm explorations of history's most profound moments, a like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community of thoughtful listeners. So settle in. Let your shoulders drop away from your ears, take a slow breath, in through your nose, out through your mouth, and let's begin our slow drift through the early 1900s, through the panic, through the rescue, and toward understanding. There's nowhere you need to be, no deadlines to meet. Just listen and let the story unfold like a long, quiet conversation between old friends. Let it wash over you. If you drift away, that's perfectly fine. That's what we're here for. Let's begin in the year 1900, when the 20th century was young and America was transforming. The United States at the turn of the century was a nation in the midst of extraordinary change. The Civil War was a generation in the past. The frontier, according to the Census Bureau, had officially closed in 1890. America was no longer a rural agricultural nation looking westward for expansion. It was becoming an industrial giant, an urban society, a modern economy that would soon rival and then surpass the great powers of Europe. Consider the scale of transformation. In 1860, before the Civil War, America had been primarily agricultural. Most people lived on farms or in small towns. Manufacturing existed, but was modest. The economy produced goods mainly for local consumption. But by 1900, everything had changed. Steel production had increased more than 50-fold since 1870. Railroad mileage had expanded from about 50,000 miles to nearly 200,000 miles, knitting the continent together into a single economic unit. Cities had exploded in size, New York, Chicago, Philadelphia, becoming centers of industry, commerce, and immigration. The rise of great corporations was perhaps the most distinctive feature of this new economy. Companies of unprecedented size and power emerged, dominating entire industries. Standard Oil controlled roughly 90% of oil refining. United States Steel, formed in 1901, was the world's first billion-dollar corporation. These companies weren't just large. They operated on a scale that transformed how business worked, how markets functioned, how economic power was distributed. The men who built these corporations became known as titans of industry, though their critics called them robber barons. John D. Rockefeller in oil, Andrew Carnegie in steel, though he would sell his company in 1901. Cornelius Vanderbilt and later E. H. Harriman in railroads, and towering above them all, in terms of financial power, if not personal wealth, was John Pierpont Morgan. J.P. Morgan was different from the other great industrialists. He didn't extract oil or produce steel or operate railroads, though he controlled companies that did all these things. Morgan was a banker, but that simple description doesn't capture his role. He was an organizer of capital, a creator of trusts, a man who could assemble the financial resources to build industries or rescue them from collapse. His bank, J.P. Morgan and Company, was the most powerful private financial institution in America, perhaps in the world. Morgan's power came from several sources. First, his bank had enormous capital and access to more capital through connections with European banks, particularly in London. When American companies needed to raise large sums of money, they came to Morgan. Second, Morgan had a reputation for probity and judgment. When he backed something, investors trusted it. His name on a deal was as good as gold. Third, and perhaps most importantly, Morgan believed in his own authority. He acted as though he had the right to organize industries, to dictate terms, to make decisions that affected the entire economy. And remarkably, people accepted this authority. By 1900, Morgan had orchestrated numerous corporate consolidations. He had reorganized failing railroads, creating the Southern Railway system. He had mediated disputes between competing industrialists. He had arranged international loans. He moved through the worlds of finance, industry, and politics with an assurance that bordered on arrogance, but was backed by genuine capability and resources. The America of 1900 had no central bank. This is crucial to understanding what would happen in 1907. The First Bank of the United States and the Second Bank of the United States had both been allowed to expire in the 19th century, victims of political opposition to concentrated financial power. Since 1836, America had operated without a central institution that could regulate money supply, act as lender of last resort, or coordinate responses to financial crisis. There were thousands of banks operating independently under state or federal charters with no central authority. This system worked reasonably well in normal times. Banks made loans, accepted deposits, facilitated commerce. But the system had a fundamental vulnerability. Banks operated on fractional reserves. They lent out most of the money deposited with them, keeping only a fraction in reserve. This was efficient and profitable, but it meant banks were vulnerable to runs. If depositors lost confidence and demanded their money simultaneously, even a sound bank could fail, because it didn't have everyone's cash sitting in a vault. In countries with central banks, there was an institution that could provide liquidity during a panic, lending to sound banks that faced temporary runs. But America had no such institution. Instead, during crises, private bankers, primarily Morgan, had to perform this function. Morgan had done this before, most notably in 1895 when he helped rescue the federal government itself by organizing a gold loan to support the Treasury. This was an extraordinary situation, a private banker rescuing the government, but it demonstrated Morgan's power and his willingness to act as a kind of unofficial central banker. The economy in the early 1900s was booming, but also unstable. Stock market speculation was common. Credit was easy to obtain. Prices were rising. There was a sense that America was entering a golden age of prosperity. That industrial progress would continue indefinitely. This optimism fueled investment and growth, but it also created conditions for excess. Trust companies were particularly significant in this era. These were financial institutions that performed some banking functions but were less regulated than national banks. They accepted deposits, made loans, and increasingly engaged in stock market speculation. Trust companies could legally do things that banks couldn't, or at least face fewer restrictions. They grew rapidly in the early 1900s, attracting deposits by offering higher interest rates than banks. By 1907, trust companies held enormous amounts of depositor money and had become deeply involved in financing stock market speculation and corporate mergers. The Knickerbocker Trust Company was one of the largest and most prestigious trust companies in New York. Its president was a man named Charles T. Barney, socially prominent, well-connected, a figure of respectability in New York financial circles. Knickerbocker Trust had assets of over $60 million and was considered absolutely sound. Depositors included wealthy individuals, businesses, other financial institutions. It was exactly the kind of institution that people trusted with their money. Another important trust company was the Trust Company of America, smaller than Knickerbocker but still significant. And there were numerous others: Lincoln Trust, Farmers Loan and Trust, dozens of institutions that together held hundreds of millions of dollars in deposits and had extended hundreds of millions more in loans, much of it secured by stock market collateral. The stock market itself was a different creature than it would later become. Trading was concentrated on the New York Stock Exchange, located on Wall Street in Lower Manhattan. The exchange was a private club, with seats that could be bought and sold and strict rules about who could trade and how. Stocks were traded in person, on the floor, with runners carrying orders and information. The famous stock ticker, which transmitted prices across telegraph lines, allowed people outside the exchange to follow the market, but actual trading required physical presence. Speculation was rampant. People bought stocks on margin, meaning they borrowed money to purchase stocks, using the stocks themselves as collateral. If the stock went up, they could sell at a profit and repay the loan. If it went down, they might face margin calls, demands to put up more cash or see their stocks sold. This system amplified both gains and losses, and it meant that stock market declines could cascade as forced selling drove prices down further, triggering more margin calls and more forced selling. Into this complex, interconnected and vulnerable financial system, the year 1907 arrived with deceptive calm. The economy was strong, the stock market had been rising. President Theodore Roosevelt in his second term was pursuing progressive policies, breaking up monopolies, regulating railroads, conserving natural resources. But these policies, while controversial with business interests, didn't seem to threaten immediate crisis. Yet beneath the surface, strains were building. Credit had been extended aggressively. Stock prices had risen beyond what underlying company profits justified. Some financiers had overreached, taking on debt to finance ambitious plans. The system was stretched thin, operating with minimal reserves, vulnerable to any shock that might cause people to question the soundness of institutions or the value of collateral. The stage was set, though nobody quite realized it yet. Wall Street went about its business. Bankers made loans. Investors bought stocks. Trust companies accepted deposits and put the money to work. And J.P. Morgan, 70 years old in 1907, was considered the most powerful private citizen in America, a man who had rescued the financial system before and who, if necessary, might be called upon to do so again. Nobody imagined just how necessary that would become, or how close the entire system would come to complete collapse before autumn ended. Let's pause there for a moment. Let that image settle. America in 1907, powerful and prosperous but also vulnerable. Its financial system an intricate web of trust and credit, with no central authority, no safety net, depending on the soundness of thousands of individual institutions and ultimately on the confidence of millions of depositors. It was a system that worked beautifully until it didn't. And when confidence broke, when trust evaporated, the system could collapse with terrifying speed. We'll see that happen soon enough, but there's no rush. We have time to understand how we got there. The year 1907 began with what seemed like minor tremors, financial disturbances that most people dismissed as temporary adjustments in an otherwise healthy economy. But these tremors were early warnings of the earthquake that would come in autumn. let's trace how the crisis built, slowly and then suddenly, how confidence eroded and panic took hold. The first significant shock came in March, when a steep decline in the stock market caught investors off guard. Prices that had been rising steadily suddenly fell sharply. The immediate cause was complex: concerns about President Roosevelt's antitrust policies, tightening credit conditions, profit-taking after a long bull market. But the effect was clear. Investors who had bought stocks on margin faced calls for additional capital. Some couldn't meet these calls and were forced to sell, which drove prices down further. The market stabilized after a few weeks, but it had revealed fragility that many hadn't recognized. Then in June, another disturbance rippled through the financial system. The stock market fell again, more sharply this time. Banks and trust companies that had lent money secured by stock collateral suddenly found that collateral was worth less than the loans. This made them nervous about extending new credit. As credit tightened, businesses found it harder to borrow for operations or expansion. The economy, which had been growing vigorously, began to slow, but these were still considered normal market fluctuations. The system had weathered such disruptions before. Most bankers and businessmen believed the fundamentals were sound, that any downturn would be brief and mild. They couldn't see, or didn't want to see, how interconnected everything had become, how vulnerable the system was to loss of confidence. In October, the crisis moved from abstract market forces to specific institutions and individuals. And it began, as many financial crises do, with one man's ambition and subsequent failure. F. Augustus Heinze was a copper magnate from Montana who had made a fortune in mining. He was flamboyant, aggressive, willing to take risks that more conservative businessmen avoided. Heinze had come to New York and, along with his brother Otto and a financier named Charles W. Morse, had gained control of several banks and trust companies. Their plan was to use these institutions to finance stock market speculation, particularly in shares of United Copper Company, a firm in which the Heinze brothers had substantial holdings. The scheme was audacious. Otto Heinze believed that much of United Copper's stock had been sold short. That is, speculators had borrowed shares, sold them, and hoped to buy them back later at lower prices to return to the lenders and pocket the difference. If this was true, and if the Heinzes could corner the market by buying up all available shares, they could force the short sellers to buy from them at whatever price they demanded. It was a classic corner, the kind of manipulation that could generate enormous profits if it worked. On Monday, October 14th, Otto Heinze began buying United Copper shares aggressively, trying to corner the market. The stock price rose from $39 per share to $60 in a single day. It seemed the corner was working. Otto demanded that short sellers deliver their borrowed shares, expecting they would be unable to do so and would have to pay whatever he asked. But the corner failed. It turned out the short interest wasn't as large as the Heinzes believed, or the short sellers found shares from sources the Heinzes hadn't controlled. Instead of being caught in a squeeze, the short sellers delivered their shares. Otto Heinze was suddenly holding vast quantities of United Copper stock he had bought at inflated prices, financed with borrowed money. The stock price collapsed, falling back to below $10 per share. The Heinze brothers lost millions, money they didn't have. This would have been merely a spectacular individual failure, a cautionary tale about speculation and hubris, except for one crucial fact. The Heinzes had used banks and trust companies they controlled to finance the corner. When the corner failed, these institutions faced enormous losses. Depositors, reading about the failed corner in newspapers, began to worry. If the Heinzes had used their bank's money for wild speculation, were those banks sound? Should depositors get their money out while they still could? On Tuesday, October 15th, runs began on the banks associated with the Heinzes and Morse. Depositors lined up to withdraw their money. The banks tried to meet the demands, paying out cash to anyone who wanted it, but their reserves were limited. They had lent out most of their deposits. They couldn't immediately call in loans or sell assets to raise cash. The classic banking dilemma was unfolding. Institutions that were solvent, that had assets exceeding liabilities, but lacked liquid cash to meet immediate demands. The Clearinghouse Association, an organization of major New York banks, met to assess the situation. The clearinghouse existed partly to handle the daily settlement of checks and transactions between banks, but it also served as a kind of mutual support system during crises. Banks in the clearinghouse could provide liquidity to member institutions facing temporary difficulties, but the clearinghouse made a harsh decision. It would not support the banks controlled by the Heinzes and Morse. These institutions had been used for speculation, had engaged in practices the conservative bankers of the clearinghouse disapproved of. Let them fail. Let it be a lesson. So the banks connected to the Heinz and Morse circle failed, one after another. Depositors lost money. The Heinz brothers were ruined, their personal fortunes wiped out along with the banks they had controlled. Charles Morse would eventually be indicted for violation of banking laws. It was a spectacular collapse. But it was still contained. The major banks seemed unaffected. The trust companies seemed solid. The crisis appeared to be limited to a few reckless institutions and the men who had misused them. But financial panics don't respect boundaries. Fear spreads. Depositors began to wonder, if those banks could fail, what about other banks? What about trust companies? If respectable-seeming institutions could suddenly collapse, how could anyone know which institutions were safe? The psychology of panic is contagious. Each failure increases fear, which leads to more withdrawals, which causes more failures. On Monday, October 21st, attention shifted to the Knickerbocker Trust Company. Remember, Knickerbocker was one of the largest and most prestigious trust companies in New York, with over $60 million in assets. Its president, Charles Barney, was socially prominent, trusted. But Barney had a connection to Charles Morse. They were business associates. They had been involved in various ventures together. Was Knickerbocker exposed to the failed Heinz and Morse schemes? Had Barney used Knickerbocker funds unwisely? Rumors spread through New York's financial district. People talked. Newspaper reporters asked questions. Depositors grew nervous. Some began withdrawing their money from Knickerbocker, not in panic yet, but cautiously, prudently, just to be safe, just until things became clearer. The directors of Knickerbocker Trust met urgently. They needed to restore confidence. The way to do this, they decided, was to remove Charles Barney as president, even if Barney hadn't done anything wrong. His association with Morse was damaging Knickerbocker's reputation. On Monday evening they demanded his resignation. Barney, shocked and humiliated, complied. He resigned, hoping this sacrifice would save the institution he had led. But removing Barney had the opposite effect. Instead of reassuring depositors, it confirmed their worst fears. If Knickerbocker's directors had forced out their president, something must be seriously wrong. On Tuesday morning, October 22nd, when Knickerbocker Trust opened its doors, depositors were waiting. Not dozens, but hundreds of people, all demanding their money. Picture the scene outside Knickerbocker's main office at 5th Avenue and 34th Street. It was a beautiful building, solid and imposing, meant to inspire confidence. But on this Tuesday morning, a crowd gathered, growing throughout the day. At first, people were relatively calm, orderly. But as the line grew longer, as hours passed and people waited, anxiety increased. Would there be enough money? Would the bank run out before everyone could withdraw? The fear became self-fulfilling. People who hadn't planned to withdraw saw the crowd and joined it. If everyone else was pulling money out, shouldn't they do the same? Inside, Knickerbocker's staff tried desperately to meet the demand. Tellers counted out cash. Vault doors swung open repeatedly as more currency was brought out. But the bank's cash reserves were finite. By early afternoon, it became clear that Knickerbocker couldn't meet the withdrawals. The bank had plenty of assets, loans, securities, real estate, but it couldn't convert these assets to cash quickly enough. At approximately 3 o'clock in the afternoon, Knickerbocker Trust suspended operations. The doors closed. People still in line were turned away. The third largest trust company in New York had failed. The failure of Knickerbocker was catastrophic, not just for its depositors but for the entire financial system. Knickerbocker had been considered absolutely sound. If it could fail, any institution could fail. The panic that had been building for a week exploded into full-blown crisis. On Wednesday morning, October 23rd, runs began at other trust companies across New York. The Trust Company of America faced enormous withdrawals. So did Lincoln Trust, Farmers Loan and Trust, and numerous smaller institutions. Depositors weren't making careful judgments about which institutions were sound and which weren't. They were simply trying to get their money out of any trust company before it failed. The distinction between sound and unsound institutions collapsed. All that mattered was getting your money first. The Trust Company of America was particularly vulnerable. It was a substantial institution with about $60 million in assets, but much of its capital was tied up in loans and securities. On Wednesday, it faced withdrawal demands of more than $8 million. The trust company paid out as much as it could, draining its reserves. By late afternoon, it was on the verge of suspension, of closing its doors and admitting it couldn't meet demands. This was when J.P. Morgan entered the crisis directly. Throughout the previous week, Morgan had been watching events with concern but hadn't yet intervened personally. He was 70 years old, suffering from a bad cold, and might have been forgiven for letting others handle the situation. But as Tuesday afternoon turned to evening, as news of Knickerbocker's failure spread, Morgan understood that this was no ordinary panic. The entire trust company system was on the verge of collapse, and if the trust companies failed, the banks would be next. The panic would spread to the whole financial system. It could bring down the economy. Morgan acted with characteristic decisiveness. On Tuesday evening, he convened a meeting at his library, a magnificent building adjacent to his home on Madison Avenue that housed his art collection and served as his private office. To this meeting came the presidents of major banks and trust companies, government officials, anyone with power to affect the situation. Morgan wanted to assess how bad things were and what could be done. The meetings would continue for days, running late into the night, with Morgan at the centre, questioning, analysing, making decisions. He was conducting a kind of triage, deciding which institutions could be saved and which were too far gone, determining how much money would be needed and where it could come from, orchestrating a rescue operation that no government agency existed to perform. On Wednesday morning, when the Trust Company of America faced imminent failure, Morgan made a crucial decision. The Trust Company of America would be supported. It would not be allowed to fail. Morgan personally pledged resources and convinced other major banks to do the same. Throughout Wednesday, as depositors lined up outside the Trust Company of America, cash was rushed from other institutions to keep it paying. Every withdrawal was met. The doors stayed open. This was enormously expensive and risky for the banks providing support. They were extending credit based on Morgan's assurance that the Trust Company of America was fundamentally sound, that this was a panic-driven run, not a reflection of actual insolvency. If Morgan was wrong, if the Trust Company of America did turn out to be insolvent, the supporting banks would lose millions. But Morgan's reputation and judgment were such that banks trusted him. Or perhaps more accurately, they feared what would happen if they didn't cooperate. Morgan could be intimidating. When he decided something needed to be done, he expected compliance. The support worked, but just barely. The Trust Company of America survived Wednesday, paying out over $30 million to withdrawals, but it was exhausted. Its reserves were gone. It could only continue operating if more support arrived on Thursday. And Thursday would bring its own crises. Thursday, October 24th, was in some ways the worst day of the panic. The stock market, which had been declining throughout the week, went into free fall. Brokers who had lent money for stock purchases demanded repayment as the value of stock collateral fell. Margin calls went out by the hundreds, by the thousands. Investors who couldn't meet the calls saw their stocks sold, which drove prices down further, triggering more margin calls. It was the same vicious spiral that would happen on a much larger scale in 1929, but it was terrifying enough in 1907. By early afternoon, Thursday, the stock market was in chaos. The president of the New York Stock Exchange sent word to Morgan. If major loans couldn't be arranged immediately to provide liquidity for brokers, the exchange would have to close. Closing the exchange had never happened before in peacetime. It would signal complete financial breakdown. It couldn't be allowed to happen. Morgan again assembled the major bankers. He needed to raise $25 million within minutes to provide loans to brokers and prevent the exchange from closing. This was an enormous sum. The banks were already stretched thin from supporting trust companies, but Morgan was insistent it had to be done. The bankers, reluctantly or willingly, committed the funds. By 3 o'clock Thursday afternoon, just before the market's normal closing time, word spread that $25 million in loans were available. The panic in the stock market eased, prices stabilized, the exchange stayed open. But even as the stock market crisis was addressed, the runs on trust companies continued. The Trust Company of America faced another day of massive withdrawals on Thursday. Other trust companies were also under pressure. Each institution that failed, or came close to failing, increased the panic. Depositors who read about these failures in newspapers became more determined to withdraw their money. The papers were full of dramatic accounts, sketches of crowds outside trust companies, stories of wealthy men and women reduced to waiting in line with everyone else, desperate to save what they could. Friday brought a brief respite. The weekend would provide time to organise more support, to arrange more loans, to let panic subside somewhat. But everyone knew that Monday would be critical. Would the support hold? Would depositors regain confidence? Or would the panic intensify, spreading from trust companies to banks, from New York to the rest of the country? Through all of this, Morgan was orchestrating responses from his library. He barely slept, working through nights with teams of lawyers, accountants, and bankers, examining the books of troubled institutions, deciding which could be saved and which had to be let go, arranging pools of money to support the chosen institutions. He was performing the function that a central bank would have performed in other countries, providing liquidity, coordinating responses, maintaining the system. But he was doing it as a private citizen, using his own fortune and his power to persuade others to contribute theirs. The next week would test whether even Morgan's enormous resources and authority were sufficient to stop a panic that had taken on a life of its own. Let that thought rest for a moment. Picture Morgan in his library, 70 years old, exhausted, ill with a cold, bearing the weight of the entire financial system on his shoulders because there was nobody else to bear it. The government couldn't help. It had no tools, no institutions designed for this kind of crisis. Everything depended on one man's judgment, his reputation, his willingness to risk his own fortune to save institutions that weren't his own, to preserve a system that perhaps needed preserving, but that had made him extraordinarily powerful, precisely because it lacked the public institutions that might have constrained him. The ironies and contradictions of the situation were profound, but there was no time to contemplate them. The crisis demanded action. And Morgan, whatever his motivations, whatever his flaws, was willing to act. The weekend provided a brief pause in the panic, a moment for exhausted bankers to assess the damage and plan their next moves. But it was a tense pause, not a restful one. Everyone knew that when the banks and trust companies opened their doors on Monday morning, October 28th, the crisis would either begin to resolve or spiral completely out of control. Morgan spent Saturday and Sunday in continuous meetings at his library. The building on Madison Avenue had become the de facto headquarters for managing the crisis, the closest thing America had to a central bank. Bankers arrived and departed at all hours. Messengers rushed between the library and various financial institutions. Accountants pored over books trying to determine which troubled institutions were fundamentally sound and which were genuinely insolvent. The distinction was crucial. A sound institution facing a panic-driven run deserved support. It could repay any loans once confidence returned. But an insolvent institution, one whose liabilities exceeded its assets, couldn't be saved. Pouring money into such an institution would be throwing good money after bad. Morgan's task was to make these judgments quickly, with incomplete information, knowing that wrong decisions could either waste resources that were desperately needed elsewhere, or allow preventable failures that would deepen the panic. The Trust Company of America remained the most pressing concern. It had survived the previous week only through massive support from other institutions. Over those terrible days, it had paid out more than $34 million in withdrawals, more than half its total deposits. It was still operating, still paying anyone who wanted their money, but it was surviving hour by hour, dependent on continued support. If that support wavered, if other banks decided they had extended enough credit and would provide no more, the Trust Company of America would fail immediately. Morgan examined the Trust Company of America's books throughout the weekend. He questioned its officers relentlessly. What were its assets? What were its liabilities? How much of its loan portfolio was good? How much was questionable? Could it survive if the panic subsided? The answers apparently satisfied him. Morgan concluded that the Trust Company of America was fundamentally sound. Yes, it had been aggressive in its lending. Yes, it had engaged in some speculation. But its assets, if given time to be liquidated in an orderly fashion, would cover its liabilities. It deserved to be saved. But saving it would require money that Morgan alone didn't have. He needed the cooperation of the major banks, the very institutions that were members of the Clearinghouse Association. And here Morgan faced a problem. Many of the conservative bankers who ran these institutions looked down on trust companies. They considered them reckless, poorly regulated, engaged in speculation that proper banks avoided. Why should the banks risk their own resources to save institutions that had brought trouble on themselves through imprudent behaviour? Morgan had to convince them. He had to make them understand that this wasn't about rewarding imprudence or bailing out competitors. This was about preventing the collapse of the entire financial system. If the trust companies failed en masse, the panic would spread to the banks themselves. No institution would be safe. The bank's own survival depended on stopping the panic now, even if that meant supporting institutions they disapproved of. It's worth pausing to consider Morgan's position and power in this moment. He was not a government official. He held no elected position, had no legal authority to compel anyone to do anything. Yet he was able to summon the presidents of the major banks to his private library and, through force of personality and persuasion, convince them to commit millions of dollars to rescue operations. This power came partly from his wealth, partly from his reputation and past successes, but mostly from the simple fact that everyone recognized there was no alternative. Someone had to coordinate the response, someone had to make decisions the government couldn't or wouldn't, so Morgan did. On Sunday evening, Morgan met with George Cortelyou, the Secretary of the Treasury in President Roosevelt's administration. Cortelyou had come to New York as the crisis deepened, recognizing that the federal government needed to do something, though its options were limited. The Treasury had some funds that could be deposited in New York banks, providing them additional reserves. Cortelyou committed to depositing $25 million in government funds, a substantial sum that would help but wouldn't be sufficient by itself. The government was providing what support it could, but the burden of the rescue still fell primarily on Morgan and the private bankers. Monday morning arrived with a mixture of dread and determination. Would the support hold? Would depositors continue withdrawing? The newspapers that morning carried accounts of the previous week's events, some sensational, some measured, all read avidly by a public trying to understand what was happening to their money, their economy, their country. The Trust Company of America opened its doors. A crowd had gathered. But it was smaller than the previous week. Perhaps the support announced over the weekend had reassured some depositors. Perhaps others had already withdrawn what they wanted. Withdrawals continued through Monday, but at a slower pace. The institution survived another day. It was progress, though fragile progress. But even as the situation at the Trust Company of America stabilized somewhat, a new crisis emerged. The crisis would come from an unexpected direction. The city of New York itself needed money, and the complexity of saving it would test even Morgan's abilities. The city government had been planning to issue $30 million in bonds to fund various projects: infrastructure, schools, normal municipal activities. These bonds were supposed to be sold to investors, providing the city with immediate cash that would be repaid over time through tax revenues. But in the midst of financial panic, nobody wanted to buy city bonds. Investors were hoarding cash, not committing to long-term investments in municipal debt. The bond sale was failing. This wouldn't normally have caused an immediate crisis. The city could simply delay its projects, postpone spending. But the problem was more urgent. The city had short-term obligations coming due soon, payments that had to be made, debts that couldn't be postponed. If the city couldn't raise money by selling its bonds, it would default on its obligations. New York City, the financial capital of America, would be bankrupt. The implications were staggering. If New York City defaulted, confidence in all municipal bonds would collapse. Cities across the country depended on being able to borrow by issuing bonds. If that market froze, urban governments would be paralyzed. Beyond that, many banks and trust companies held city bonds as assets. If those bonds became worthless, or even if they simply couldn't be sold, the balance sheets of financial institutions would deteriorate further, potentially triggering more failures. The city's mayor and comptroller came to Morgan, explaining the situation, asking for help. Morgan listened, asked questions, and began working on a solution. It would require getting banks to agree to accept city bonds as collateral for loans, essentially agreeing to buy the bonds in a way that would allow the city to meet its obligations. But banks were reluctant. Why should they take on city bonds when they were already stretched thin supporting trust companies and providing loans to stockbrokers? Once again, Morgan had to persuade, cajole, and insist. He spent Monday evening meeting with bank presidents, explaining why saving the city was necessary. Some were convinced by economic arguments. The cascading effects of a city default would ultimately hurt everyone. Others responded more to Morgan's insistence, his implicit threat that refusing to cooperate would mean being excluded from future dealings, being marked as someone who wouldn't help during crisis. Morgan's power included the power to ostracize, and that power was as important as his capital. By late Monday night, an agreement was reached. A syndicate of banks would take $50 million of city bonds, providing the city enough liquidity to meet its immediate obligations. The crisis was resolved, at least temporarily. New York City would not default. But the episode demonstrated how interconnected everything was, how a panic that started with speculation in copper stocks could threaten the solvency of the nation's largest city. Tuesday and Wednesday brought continued pressure, but no new catastrophic failures. The trust companies continued to face withdrawals, but at declining rates. The worst seemed to be passing. People who had withdrawn money were finding they had nowhere better to put it. You couldn't keep large amounts of cash safely at home, and moving money to another institution was pointless. If that institution might also fail, gradually, reluctantly, confidence was returning. But Morgan wasn't satisfied with simply preventing collapse. He saw an opportunity to solve a longer-term problem, and solving it would require one more dramatic intervention, one that would prove controversial and would raise questions about the proper limits of private power. The problem involved a major brokerage firm called Moore and Schley. This firm was deeply involved in financing stock purchases, and it had extended enormous credit secured by shares of a company called Tennessee Coal and Iron. Tennessee Coal and Iron was a substantial company, producing steel and operating mines in the South. But it wasn't performing well financially, and its stock price had fallen during the October panic. Moore and Schley, holding millions of dollars in loans secured by this declining stock, was in danger of failure. If Moore and Schley failed, it would have to dump its Tennessee Coal and Iron shares on the market, driving the price down further, potentially triggering more brokerage failures in another cascade effect. Morgan had been thinking about Tennessee Coal and Iron for reasons unrelated to the panic. United States Steel, the corporation Morgan had created in 1901 and still influenced strongly, had long wanted to acquire Tennessee Coal and Iron. Owning it would give U.S. Steel control of Southern steel production, access to valuable iron ore reserves, elimination of a competitor. But there were complications. U.S. Steel was already enormous, already facing antitrust scrutiny from the Roosevelt administration. Acquiring another major steel company might trigger antitrust action. Morgan saw a way to solve multiple problems simultaneously, if U.S. Steel acquired Tennessee Coal and Iron. It would take those shares off Moore and Schley's hands, preventing the brokerage's failure. U.S. Steel would get an asset it wanted, and this could all be presented as a public service, a rescue operation necessitated by the panic, not a business acquisition for competitive advantage. It was brilliant in its way, using crisis as opportunity, serving private interests while claiming public benefit. But it required political approval. President Roosevelt would have to agree not to pursue antitrust action against U.S. Steel for this acquisition. On Saturday morning, November 2nd, 2 U.S. Steel executives took a train to Washington to meet with Roosevelt. They explained the situation, Moore and Schley's danger, the risk of renewed panic, the proposed acquisition as solution. They emphasized that U.S. Steel was acting for public benefit, that Morgan had asked them to make this acquisition to prevent financial crisis, that they were acting reluctantly, only out of civic duty. Roosevelt, after consulting with his cabinet, agreed. He would not oppose the acquisition. Whether he fully believed the civic duty story, whether he recognized the private benefits U.S. Steel would gain, whether he felt he had any choice given the ongoing crisis, these questions can't be answered with certainty. But he gave approval. U.S. Steel would acquire Tennessee Coal and Iron for approximately $30 million, paid in U.S. Steel bonds. Moore and Schley would be saved, and Morgan would have accomplished something he had wanted for years, securing it under crisis conditions that made opposition difficult. The acquisition would later be controversial. Critics argued that Morgan had manipulated the crisis, or at least exploited it, to achieve a competitive advantage for U.S. Steel. Some claimed Tennessee Coal and Iron was worth far more than the $30 million paid, that it was acquired at a bargain price while everyone was too panicked to object properly. The episode would later be investigated, would become evidence for those who argued that concentrated private power was dangerous, that someone with Morgan's influence could shape events for private benefit while claiming public service. But in November 1907, what mattered most was that the various supports and interventions were working. The panic was subsiding. The trust companies, while weakened, were surviving. The banks had weathered the storm. The stock market was stabilizing. The city had its financing. Gradually, life was returning to normal. By mid-November, the worst was clearly over. Depositors stopped withdrawing their money. Some even began redepositing funds they had withdrawn during the panic. The trust companies that had survived began rebuilding their reserves. Interest rates, which had spiked during the crisis as demand for liquid capital overwhelmed supply, began to decline back toward normal levels. The economy, which had contracted sharply during the panic, began to recover. The direct economic damage was substantial but not catastrophic. Several banks and trust companies had failed, with depositors losing money. Stock portfolios had been devastated. Many investors were ruined. Credit had contracted, hurting businesses. The economy would enter a recession that would last into 1908, with unemployment rising and production declining. But it wasn't a depression. The financial system had survived. Commerce continued. The damage, while real, was limited compared to what might have been. The human toll was harder to measure but no less real. Charles Barney, the former president of Knickerbocker Trust who had been forced to resign, shot himself 3 weeks after Knickerbocker's failure. He died of his wounds several days later, a broken man who felt he had been unjustly blamed for the panic, his reputation destroyed, his life's work undone. His suicide was a reminder that financial crises, even when resolved at the systemic level, leave individual casualties, personal tragedies that don't appear in economic statistics. For J.P. Morgan, the crisis solidified his reputation as the most powerful private citizen in America. He had saved the financial system. He had prevented catastrophe. His critics might argue about his methods, about whether he had gained personally from the crisis, about whether one man should have so much power. But nobody could deny that he had acted decisively when action was needed, that he had risked his own resources and reputation, that without his intervention the panic would likely have been far worse. Morgan himself seemed exhausted by the experience. He was 70 years old and had worked nearly without rest for 2 weeks during the worst of the crisis. His health had suffered, but he had done what he considered necessary, what he perhaps considered his duty, whether from civic responsibility, from self-interest in protecting a system that had made him rich, from simple inability to stand aside while crisis unfolded, or from some combination of all these. Morgan had acted, and his action had made the difference between crisis contained and crisis spiralling into catastrophe. Let's rest here for a moment. Let the weight of those October and November days settle. Picture the crowds outside trust companies, the urgent meetings in Morgan's library, the decisions made under pressure with incomplete information, the fear and uncertainty that gripped New York and spread across the country. Picture Morgan, old and ill, bearing responsibility that shouldn't have fallen to any private citizen, using power that perhaps no private citizen should have had, saving a system that had made him powerful precisely because it lacked the public institutions that might have prevented the crisis in the first place. Hold these images gently. The crisis was over, but its lessons and its legacy were just beginning to unfold. As the immediate crisis faded and normalcy gradually returned to the financial district, people began to ask difficult questions. How had this happened? Why had the richest, most advanced economy in the world come so close to complete financial collapse? And most pressingly, what should be done to prevent it from happening again? The answers to these questions would transform American finance, would create institutions that persist to this day, would shift the balance of power between private bankers and public authority. But these transformations didn't happen immediately or easily. They emerged slowly from debate, from political struggle, from the gradual recognition that the system that had nearly failed needed fundamental reform. Let's understand what had made the system so vulnerable. At its core, the problem was one of liquidity and confidence. Banks and trust companies operated on fractional reserves, holding only a small portion of deposits as cash while lending out the rest. This made perfect sense in normal times. Money sitting idle in vaults earned nothing, while money lent out earned interest. But it meant that no institution could survive if all its depositors wanted their money simultaneously. In countries with central banks, there was an institution that could provide emergency liquidity. When a sound bank faced a run, the central bank could lend it cash against its assets, allowing it to meet withdrawals until confidence returned. This function, called lender of last resort, was crucial to financial stability. But America had no central bank. When panic struck, there was no public institution to provide this function. Private bankers, primarily Morgan, had to improvise. The improvisation had worked in 1907, but barely. It had required one man with enormous resources and authority, along with the cooperation of others who trusted or feared him enough to follow his lead. What would happen next time? Morgan was 70 years old. He wouldn't live forever. Would there be someone else with similar resources and authority? Could the country afford to depend on the chance that such a person would exist when needed? These questions were being asked not just by economists and bankers, but by politicians and the public. The panic had frightened people. Middle-class families who thought their savings were safe had discovered they weren't. Businesses had found they couldn't get credit they needed. The economy had contracted, throwing people out of work. There was anger at the financiers who seemed to have caused the crisis through speculation and mismanagement, and also fear that it could happen again. President Theodore Roosevelt had complicated feelings about the crisis and its resolution. He was grateful to Morgan for preventing complete collapse. But he was also uncomfortable with the power Morgan had wielded. Roosevelt was a progressive, believing in active government, in regulation of business, in breaking up monopolies and trusts that concentrated power. He had spent much of his presidency fighting against concentrated private power, yet the crisis had demonstrated that sometimes concentrated private power was the only thing standing between the country and disaster. This contradiction troubled him. Roosevelt called for investigation and reform. In December 1907, he sent a message to Congress describing the panic and calling for measures to prevent recurrence. He supported the idea of strengthening the national banking system, providing more flexibility in currency supply, creating mechanisms for providing emergency credit. But he didn't call for a central bank specifically. That idea was politically toxic. Americans had rejected central banks twice before in their history, mistrusting concentrated financial power, whether public or private. In Congress, debate began about financial reform. Some representatives, particularly those from agricultural and Western states, blamed Wall Street speculation for the crisis. They wanted stricter regulation of banks and trust companies, limits on stock market speculation, prosecution of financiers who had engaged in manipulation. Others argued that overregulation would stifle economic growth, that the solution was to strengthen existing institutions rather than create new restrictions. The debate revealed regional and ideological divisions that had long characterized American politics. Eastern financial interests wanted reforms that would stabilize the system while preserving their power. Western and Southern agricultural interests wanted reforms that would break Wall Street's power and make credit more available to farmers. Progressives wanted government regulation and oversight. Conservatives wanted private solutions with minimal government intervention. Finding consensus among these competing interests would take years. In May 1908, Congress passed the Aldrich-Vreeland Act, an emergency measure that provided some flexibility in currency issuance during crises. It wasn't comprehensive reform, but it was a start. More importantly, the Act created the National Monetary Commission, charged with studying banking systems in the United States and abroad and recommending comprehensive reform. The Commission would spend 4 years studying the issue, travelling to Europe to examine central banks there, consulting experts, debating options. Senator Nelson Aldrich of Rhode Island chaired the commission. Aldrich was a conservative Republican, closely allied with banking interests, and his appointment worried reformers who feared any plan he developed would serve bankers rather than the public. But Aldrich took the task seriously. He recognized that the system needed reform, that another panic could be more destructive than 1907, that something substantial had to be done. Meanwhile, the economy struggled. The recession that followed the panic lasted through 1908. Unemployment rose, production declined. Businesses that had depended on easy credit found it harder to borrow. The panic's direct effects had ended, but its economic consequences persisted. People who had been prosperous in 1906 found themselves struggling in 1908. Families adjusted to reduced circumstances. Workers accepted wage cuts or lost jobs. The boom of the early 1900s seemed very far away. For the trust companies that had survived the panic, recovery was slow and difficult. They had to rebuild their reserves, restore depositor confidence, prove they were sound. Some succeeded. Others merged with banks or other trust companies, losing their independence. The trust company industry as a whole was permanently changed. The aggressive, lightly regulated institutions that had flourished before 1907 were replaced by more conservative, more heavily regulated entities. The era of the freewheeling trust company was over. Banks also became more conservative. They held larger reserves, made fewer risky loans, were more careful about their liquidity positions. This was prudent for individual institutions, but potentially harmful for the economy as a whole. If banks were too conservative, they wouldn't provide the credit that businesses needed to grow. Finding the right balance between stability and growth would prove to be an ongoing challenge, one that financial systems still grapple with today. J.P. Morgan returned to his usual activities after the crisis. He continued to organize corporate mergers, to finance international transactions, to collect art. But he was increasingly controversial. The Tennessee coal and iron acquisition came under scrutiny. Had Morgan manipulated the crisis to benefit U.S. Steel? Had President Roosevelt been deceived into approving an anti-competitive merger? A congressional committee investigated, calling Morgan and others to testify. In February 1912, Morgan appeared before the Pujo Committee, a congressional investigation into the concentration of financial power. The questioning was sometimes hostile. Representatives challenged Morgan's power, questioned his motives, implied his actions had been self-serving. Morgan, accustomed to deference and respect, found the experience degrading. He defended his actions, insisted he had served the public interest, maintained that concentrated power was necessary for financial stability. One famous exchange from the hearings captures Morgan's view of banking and trust. The committee's counsel asked Morgan what the basis of credit was, expecting him to say money or property. Morgan replied that the basis of credit was character. A man he didn't trust couldn't get money from him, no matter what collateral he offered. A man he trusted could get money without collateral. This view, that finance ultimately depended on personal relationships and trust, rather than just formal rules and assets, was revealing. It explained Morgan's power, but also the system's vulnerability. What happened when trust broke down, as it had in October 1907? The National Monetary Commission completed its work in 1912, releasing a report that ran to many volumes. Senator Aldrich proposed a plan for a National Reserve Association, a banker-controlled institution that would provide elastic currency, serve as a clearinghouse, and act as lender of last resort during crises. It was essentially a central bank, though Aldrich avoided that term because of its political toxicity. The plan provided for government oversight but left control primarily in private hands. The Aldrich plan faced immediate opposition from multiple directions. Progressive Democrats thought it gave too much power to bankers, that it would create a, quote, one controlled by Wall Street. Populists wanted something more democratic, more responsive to agrarian interests. Some conservatives thought it was too much government intervention in finance. The plan failed to pass Congress, but it had laid groundwork. The debate was no longer whether to reform the banking system, but how to reform it. The election of 1912 transformed the political landscape. Woodrow Wilson, a Democrat and progressive, won the presidency. Wilson had campaigned against concentrated economic power, promising to break up trusts and regulate business more strictly. He was no friend of Wall Street. When he turned to banking reform, he brought a different philosophy than Aldrich had. Wilson wanted a banking system with significant government control, not one dominated by private bankers. Wilson worked with Representative Carter Glass and others to craft legislation that would create a fundamentally new system, the Federal Reserve Act as it would be called. Built on the Aldrich Plan's technical foundations but altered its governance significantly. Instead of a single National Reserve Association, there would be 12 regional Federal Reserve banks, spreading power geographically rather than concentrating it in New York. These regional banks would be overseen by a Federal Reserve Board appointed by the President, providing public accountability. The system would be a hybrid, privately operated banks overseen by a public board. The debate over the Federal Reserve Act was intense and sometimes bitter. Bankers argued about the details: how many regional banks, how much autonomy they would have, who would control them. Populists wanted more government control, more responsiveness to agrarian credit needs. Conservatives worried about giving government power over currency and credit. The debate dragged through the summer and fall of 1913. On December 23, 1913, 6 years after the Panic of 1907, President Wilson signed the Federal Reserve Act into law. The United States would once again have a central banking system, though one very different from the first and second banks of the United States that had been abolished in the 19th century. The Federal Reserve System, as it was called, would have the power to issue currency, to set interest rates, to provide liquidity during crises, to regulate banks. It would, if it functioned as intended, prevent future panics by providing the lender of last resort function that had been missing in 1907. The creation of the Federal Reserve was the most important legacy of the Panic of 1907. But whether it was the right solution, whether it would prevent future crises, whether its hybrid public-private structure would work, these questions couldn't be answered in 1913. They would be tested over decades, through World War I, through the boom of the 1920s, through the Great Depression, through all the financial crises that would follow. The Federal Reserve would sometimes succeed and sometimes fail, would be reformed and modified repeatedly, would become one of the most powerful and controversial institutions in American government. J.P. Morgan did not live to see the Federal Reserve begin operations. He died in March 1913 at age 75 while travelling in Europe. His death came at the right time in some ways, before the Federal Reserve made his kind of personal dominance obsolete, before World War I transformed the world he had known. While he could still be remembered as the man who had saved the financial system in its moment of greatest danger. Morgan's estate was valued at about $68 million, a substantial fortune but smaller than many expected. Much of what people had considered Morgan's wealth was actually his power to mobilize other people's money, his ability to organize capital rather than personal ownership of it. When John D. Rockefeller heard the valuation, he reportedly said, "And to think he wasn't even a rich man." Whether this story is apocryphal or true, it captures something important. Morgan's power had come from position and reputation, more than from personal wealth, though he certainly had plenty of that too. Morgan's death marked the end of an era. The age of the individual financial titan who could single-handedly rescue the system was passing. The Federal Reserve would institutionalize the lender of last resort function, making it a public responsibility rather than a private one. This was probably necessary and certainly more democratic, but something was lost too. Morgan had acted quickly, decisively, with authority that came from personal reputation and relationships. Institutional decision-making would be more bureaucratic, more accountable, but also potentially slower and more complicated. The question of whether the Federal Reserve could actually prevent future panics remained open. Its structure was complex, its powers untested, its governance subject to political pressures. The regional Federal Reserve banks had autonomy that could lead to coordination problems. The Federal Reserve Board's relationship with the regional banks wasn't entirely clear. The system's relationship with the Treasury Department and Congress needed to be worked out through practice. Most fundamentally, the Federal Reserve faced the same basic challenge that had confronted Morgan in 1907, how to provide enough liquidity during crises without encouraging the excessive risk-taking that leads to crises. If banks and trust companies knew they would be rescued during panics, wouldn't they behave recklessly? Taking risks they wouldn't take if they bore full consequences of failure. This problem, known as moral hazard, has never been fully solved. It would plague financial regulation throughout the 20th century and into the 21st. The years immediately following the Federal Reserve's creation seemed to validate the reform. World War I broke out in Europe in August 1914, causing financial disruption as European nations mobilized their economies for war. The New York Stock Exchange actually closed for 4 months, from late July to December 1914, to prevent panic selling. But the banking system held. There was no repeat of 1907's widespread runs and failures. The Federal Reserve, though still learning to use its powers, provided stability. After the war, America entered a period of prosperity. The Roaring Twenties. Credit was abundant. Stock prices soared. The economy grew vigorously. The Federal Reserve struggled to manage this boom, uncertain how aggressively to restrain credit and speculation. Should it raise interest rates to slow speculation? Risking unemployment and recession? Or should it allow the boom to continue, accepting the risk of eventual bust? These questions had no easy answers. The boom ended, of course, in the crash of October 1929 and the Great Depression that followed. The Federal Reserve failed to prevent that crisis, failed to provide adequate liquidity as banks collapsed by the thousands in the early 1930s. The Depression was far worse than the panic of 1907 had been, lasting longer, causing greater suffering, requiring more fundamental reforms. The Federal Reserve's failure led to further reforms in the 1930s, including federal deposit insurance and more stringent bank regulation. But that's getting ahead of our story. In the years immediately following 1907, what mattered was that lessons had been learned, reforms had been implemented, institutions had been created. The financial system that emerged from the panic was different from what came before, more regulated, more public, more stable, at least in theory. Whether these changes were sufficient would be tested repeatedly over the following century, but they represented genuine progress. Genuine learning from crisis. Let's pause here and consider what the creation of the Federal Reserve meant. It represented a shift from depending on private power to creating public institutions. It acknowledged that financial stability was too important to be left to chance, to depend on whether someone like Morgan happened to exist when crisis struck. It recognized that modern economies need modern institutions, that complexity requires coordinated response, that democratic societies should have democratic control over fundamental economic levers. These insights seem obvious now, but they had to be learned through painful experience. The panic of 1907 taught them. The Federal Reserve was the institutional response, imperfect but necessary, to the vulnerabilities that panic had exposed. While institutions and policies were being debated and reformed in Washington and on Wall Street, ordinary people across America were living through the consequences of the panic. The crisis hadn't affected everyone equally, and understanding these different experiences reveals something important about how financial systems connect to daily life, how abstract matters of credit and liquidity translate into human reality. For working people in cities, the panic's most immediate effect was unemployment. As credit tightened and businesses contracted, factories laid off workers, construction projects were cancelled, shops reduced staff. Men who had steady employment in October found themselves without work by November or December, and without work there was no income. There was no unemployment insurance in 1907, no social safety net beyond private charity and family support. Picture a factory worker in Pittsburgh or Cleveland or Chicago. He might have been earning $3 or $4 a day, enough to rent a modest apartment, feed a family, save a little if he was careful. The panic hits. Credit dries up. His employer can't get loans to finance operations. Orders decline because customers can't get credit either. The factory cuts production. Workers are laid off. Our worker is suddenly without income, without savings beyond perhaps a few weeks' expenses, facing the prospect of eviction, of hunger, of watching his children suffer through no fault of his own or theirs. The psychological impact of sudden unemployment was devastating. In early 20th century America, a man's identity was closely tied to his work, his ability to provide for family. Losing employment meant losing dignity, purpose, social standing. It meant accepting charity, which carried shame. It meant looking for work day after day, being told repeatedly that nothing was available, facing the erosion of hope. Some men left their families, not out of cruelty, but because they couldn't bear to watch their children go hungry while feeling powerless to help. Women faced different but equally difficult challenges. Middle-class married women weren't expected to work outside the home in 1907. When husbands lost employment, these women had to find ways to stretch disappearing resources. They sewed clothes instead of buying them. They made do with less food, less fuel for heating, less of everything. Some took in boarders to earn money. Others did laundry or sewing for wealthier families. The work was exhausting and poorly paid, but it was better than nothing. Working-class women who had been employed before the panic often lost their jobs too. Factories that employed women in textile work or food processing laid them off. Domestic servants found positions eliminated as middle-class families economized. Young women who had been supporting themselves suddenly had no income and potentially nowhere to live. Some returned to family farms if they had them. Others accepted work under exploitative conditions because they had no alternative. Children experienced the panic's effects through their parents' anxiety and through material deprivation. Families who had been managing adequately suddenly couldn't afford necessities. Children went to school hungry. They wore threadbare clothes. They saw their parents argue about money, saw worry and fear on faces that had been cheerful before. Some children had to leave school to work, contributing whatever meagre wages they could earn. Education that might have led to better opportunities was sacrificed to immediate survival. In rural areas, the panic's effects were different but no less real. Farmers depended on credit to finance planting, buying seed, fertilizer, equipment. When credit became scarce and expensive after the panic, farmers couldn't invest in their crops. Some planted less. Others borrowed at ruinous interest rates from the only lenders still willing to extend credit. Harvest season brought low prices because everyone was selling simultaneously, and buyers couldn't get credit to purchase large quantities. Farmers who had been marginal before the panic were pushed into bankruptcy. Family farms that had been worked for generations were lost to foreclosure. The mortgage crisis in rural America deserves attention. Many farmers had taken mortgages to expand during the prosperous years of the early 1900s. These mortgages were manageable when crop prices were good and credit was available. But after the panic, crop prices fell and refinancing became impossible. Farmers faced a terrible choice: somehow scrape together mortgage payments while income declined, or default and lose everything. Many chose or were forced into the latter. Banks foreclosed. Families were evicted. Auctions were held where family possessions and land were sold to satisfy debts. These auctions were often bitter affairs, with neighbours sometimes bidding low and then returning purchased items to the family, a form of resistance and solidarity that provided small comfort in larger tragedy. Small business owners faced unique vulnerabilities. A shopkeeper, a restaurant owner, a small manufacturer. These people occupied a middle ground between workers and the wealthy. They had invested savings in their businesses, often borrowed money to establish or expand them. They depended on customers having money and credit to spend. After the panic, both disappeared. Customers stopped buying anything beyond necessities. Credit lines that had financed inventory or equipment were called in or not renewed. Many small businesses failed in the months following the panic, their owners losing not just current income but the capital they had invested over years. The banking failures affected depositors across all economic classes, but the impact varied dramatically. A wealthy person who lost deposits in a failed bank might be inconvenienced but not ruined. They likely had diversified holdings, assets beyond cash. But a working-class family that had saved diligently for years, accumulating perhaps a few $100s in a savings account, might lose everything when their bank failed. That savings represented security, the buffer against emergency, perhaps a down payment on a small home or a start for a child's future. When it disappeared, so did the family's options, their margin for error, their hope for something better. The elderly were particularly vulnerable. Before Social Security, which wouldn't be created until the 1930s, elderly people depended on savings, on family support, or on continuing to work as long as physically possible. Those who had saved carefully and deposited money in banks that failed found themselves destitute in old age. Those whose children had been supporting them found that support cut off when children lost employment. Those who depended on continuing to work found employers weren't hiring older workers when younger workers were desperate for jobs. Poor houses, those grim institutions for the indigent elderly, filled with people who had expected to end their lives with at least minimal dignity. Immigration was affected by the panic and recession. Millions of immigrants had come to America in the early 1900s, seeking opportunity, fleeing poverty or persecution in Europe. They took the hardest, lowest-paying jobs, often sending money back to family in their home countries. The panic hit immigrant communities particularly hard. As unskilled labourers, they were the first laid off when businesses contracted. As foreigners, they faced discrimination in relief efforts. Some charities prioritised native-born Americans. Some immigrants returned to their home countries, having saved nothing, their American dreams unfulfilled. Others stayed and endured, surviving through ethnic mutual aid societies, through solidarity within immigrant communities, through sheer determination. African Americans faced the recession with the added burden of pervasive racism. Excluded from most industrial jobs in many cities, relegated to the lowest paying work when they could find it, discriminated against by employers and unions alike, black workers found the panic's aftermath especially cruel. The principle of quote 3 meant black workers who had recently obtained industrial employment lost it immediately. In the South, black sharecroppers and tenant farmers faced predatory credit arrangements that kept them perpetually in debt. Arrangements that became even more oppressive when cotton prices fell after the panic. Yet within these hardships, there were also examples of resilience, mutual support, and adaptation. Communities organised relief efforts. Churches collected donations and distributed food. Settlement houses in immigrant neighbourhoods provided what assistance they could. People helped neighbours, shared what little they had. Created informal networks of support that supplemented or replaced failing formal institutions. Some individuals found opportunity in crisis. A young man willing to work for very low wages might get hired when others wouldn't. Someone with a skill, carpentry, plumbing, mechanical repair, might find work as people tried to repair rather than replace things. Entrepreneurs who had a little capital might buy distressed assets cheap. Crisis created losers but also occasional winners, though the ratio was heavily skewed toward the former. The psychological and social impacts extended beyond immediate economic hardship. Trust in institutions was damaged. People who had believed banks were safe learned they weren't. People who had believed hard work guaranteed security learned it didn't. The confidence that had characterized the early 1900s, the optimistic belief in progress and prosperity, was shaken. People became more cautious, more fearful, less willing to take risks. This caution was individually rational but collectively harmful. If everyone saved and nobody spent, if everyone hoarded and nobody invested, the economy couldn't recover. There was also anger. People wanted to blame someone for their suffering. Wall Street speculators were obvious targets. Bankers who had failed, or who seemed to profit while others suffered, were resented. There was populist anger at concentrated wealth and power. Anger that would fuel progressive political movements demanding regulation and reform. Some of this anger was justified. There had been speculation, manipulation, failures of judgment and ethics. But some was simply the human need to find someone responsible, to believe that suffering had causes that could be identified and prevented. Political radicalism increased in the recession's wake. Socialist parties gained members, labour unions became more militant. The Industrial Workers of the World, a radical union that advocated for fundamental restructuring of the economy, attracted workers who felt capitalism had failed them. These movements didn't transform America. The system proved resilient, and prosperity eventually returned. But they represented genuine dissatisfaction and desire for change. The recession following the panic was relatively short by later standards. By late 1908 and into 1909, the economy began to recover. Credit became more available. Businesses resumed hiring. Factories increased production. But recovery was uneven and incomplete. Some people and places recovered quickly. Others took much longer. And the memory of the panic and its aftermath persisted, shaping attitudes and behaviours for years. Consider a worker who found employment again in 1909 after months of unemployment in 1908. He returned to work grateful to have a job, more willing to accept lower wages or worse conditions than before the panic. He saved more of his income, afraid of being caught unprepared if crisis returned. He trusted banks less, perhaps kept more money at home despite the risks. He told his children to be careful, to save, to avoid debt, to not count on prosperity continuing. The panic had taught him vulnerability, and he didn't forget. Or consider a small town whose bank had failed during the panic. The town lost not just the bank, but the capital it had provided for local development. Businesses that might have expanded didn't. Farms that might have modernized couldn't. The town fell behind neighboring towns whose banks had survived. The failure's effects compounded over years, as lost opportunities meant less growth, which meant less opportunity, in a negative spiral that could last decades. The distribution of the panic's effects revealed and reinforced existing inequalities. Those with wealth and connections suffered least. They could weather temporary setbacks, had resources to draw on, knew people who might help them. Those without wealth or connections suffered most. They had no buffer, no safety net, no access to help beyond charity. The panic didn't create inequality, but it demonstrated how vulnerability to economic crisis was distributed along lines of class, race, geography, and access to power. This pattern, of crises affecting the vulnerable more than the powerful, was not new in 1907 and would not end there. It would repeat in every subsequent financial crisis, every recession, every period of economic disruption. The specific details would vary, but the basic dynamic would remain. Those with least bear the greatest burden when systems fail. This is not natural or inevitable. It's a consequence of choices about how systems are structured, about what protections exist, about who has power and who doesn't. But recognizing this requires seeing past aggregate statistics to individual experiences, understanding that numbers like unemployment rates represent human beings with names and faces and families. The panic of 1907 and the recession that followed taught lessons at many levels. For policymakers, it taught the need for institutional reforms like the Federal Reserve. For economists, it taught about the interconnections in financial systems and the importance of liquidity. But for ordinary people, it taught simpler, more personal lessons. It taught that security is fragile, that trust can be betrayed, that hard work doesn't guarantee protection from forces beyond individual control, that community and solidarity matter when institutions fail. These lessons were learned through experience, through suffering, through survival. They shaped the generation that lived through the panic, influencing their decisions and attitudes for the rest of their lives. Let these stories settle for a moment. Let yourself sit with the reality of what financial crisis means for people who aren't bankers or policymakers, people who just want to work and support their families and live with basic dignity. The institutional history matters, the role of Morgan, the creation of the Federal Reserve, the reforms that followed. But the human history matters too. It It reminds us that abstract economic concepts like liquidity crises and credit contraction translate into hunger and homelessness and fear. It reminds us that financial systems exist to serve people, not the other way around, and when systems fail, real people pay real prices. The panic of 1907 is long past now, but the human experiences it contained echo through all the financial crises that followed, including those we've experienced in our own time. As we move from the immediate human experiences of the panic to the broader landscape of ideas and debates it generated, we find ourselves in the realm of economic thought and political philosophy. The panic of 1907 forced Americans to reconsider fundamental assumptions about how economies should work, what governments should do, and where the proper boundaries lie between private power and public authority. Before the panic, most mainstream economic thinking in America embraced laissez-faire principles. The dominant view held that markets, left largely to their own devices, would naturally find equilibrium. Government intervention was seen as distorting these natural processes, creating inefficiencies and unintended consequences. The economy was understood as something like a machine that ran best when allowed to operate according to its own internal logic. Problems would self-correct. Crises were unfortunate but temporary, best addressed through allowing weak firms to fail while strong ones survived. This thinking had never been universal. There had always been dissenters, particularly among agrarian populists and urban reformers who saw the results of unregulated capitalism in poverty, inequality, dangerous working conditions, and concentrated power. But the mainstream economic profession, the major universities, the respectable voices in policy debates, these largely endorsed limited government and trusted markets. The panic challenged this consensus not by proving it wrong in some absolute sense, but by revealing its limitations. Yes, markets had mechanisms for self-correction, but those mechanisms operated through failure and suffering. When correction meant banks collapsing, depositors losing savings, businesses closing, workers losing jobs, when the human cost of market correction was immense and fell heavily on those least able to bear it, the question arose whether society should simply accept this as natural and inevitable, or whether institutions could and should moderate these swings. The debate wasn't really about whether to have any government involvement in the economy. Government had always been involved, through tariffs, through contracts, through legal frameworks for property and corporations, through countless other mechanisms. The question was what kind of involvement was appropriate and how much. Should government merely establish rules and then let markets operate, or should it actively manage economic conditions, smoothing cycles, preventing crises, protecting citizens from market failures? Within banking specifically, the panic made clear that fractional reserve banking was inherently unstable, without some mechanism to provide liquidity during panics. Every bank, no matter how prudently managed, was vulnerable to runs if depositors lost confidence. This wasn't a moral failing or a management problem, it was a structural feature of how banking worked. The question was what to do about it. Leave banks to survive or fail based on their ability to maintain confidence, or create an institution that could provide emergency liquidity, preventing panics from destroying sound institutions. The argument for a central bank was essentially that financial stability was a public good that markets alone couldn't provide. Just as government provided national defence or lighthouses, things that benefited everyone but that private actors couldn't profitably provide. Perhaps government needed to provide financial stability through a central banking authority. This didn't mean government controlling all banking, but it meant having an institution that could act during crises in ways private actors couldn't or wouldn't. Opposition to this idea came from several directions. Some opponents distrusted concentrated power generally, whether public or private. They feared a central bank would be captured by Wall Street interests and used to benefit bankers at public expense. This wasn't an unreasonable fear. The history of earlier central banks in America included episodes of favoritism and corruption. Why would a new central bank be different? Other opponents specifically distrusted government involvement in credit and currency. They believed politicians would manipulate monetary policy for electoral advantage, inflating the currency to please debtors while harming creditors and savers. Hard money advocates, particularly common among financial conservatives and some agricultural interests, wanted currency firmly tied to gold, preventing any authority from expanding money supply beyond what gold reserves dictated. A central bank with discretion over monetary policy threatened this constraint. Still, other opponents represented regional interests. Western and Southern states had long felt that Eastern financial institutions discriminated against them, charging higher interest rates, being less willing to lend. These regions wanted financial reforms that would weaken Wall Street's power, not create new institutions that might concentrate it further. The original Aldrich Plan, which proposed a single National Reserve Association headquartered in New York, seemed designed to perpetuate Eastern dominance. The eventual Federal Reserve structure represented a compromise among these competing concerns. Multiple regional banks distributed power geographically. A politically appointed board provided public oversight. The system would be owned by private banks but regulated by public authority. It was neither purely private nor purely public, but a hybrid, reflecting America's conflicted feelings about concentrated power and government involvement in the economy. This hybrid structure reflected deeper philosophical tensions in American political culture. Americans wanted economic dynamism, growth, entrepreneurship, things that seemed to require relatively free markets. But they also wanted stability, fairness, protection from the worst market outcomes. They wanted powerful institutions capable of coordinating complex activities, but feared concentrated power. They wanted democratic accountability, but also technical expertise and insulation from short-term political pressures. The Federal Reserve structure tried to balance all these desires, with mixed success. Beyond banking specifically, the panic influenced broader progressive-era reforms. The progressive movement, which dominated American politics from roughly the 1890s through World War I, sought to address the problems created by industrialization, urbanization, and concentrated corporate power. Progressives believed in active government, in regulation, in using state power to protect citizens and promote the general welfare. But they disagreed among themselves about methods and goals. Some progressives, like Theodore Roosevelt, believed in regulating big business rather than breaking it up. They thought large corporations were inevitable and potentially efficient, but needed government oversight to prevent abuses. Roosevelt's approach was to distinguish between good trusts and bad trusts, supporting the former while prosecuting the latter. This was pragmatic but philosophically inconsistent. Who decided which trusts were good? By what criteria? Other progressives, like Louis Brandeis, believed bigness itself was the problem. They argued that large corporations inevitably became oppressive, that they stifled competition and innovation, that they corrupted politics through their influence. Brandeis advocated breaking up large corporations, preventing combinations that concentrated power, preserving competitive markets with many smaller firms. This vision was more idealistic, but perhaps more consistent. It trusted markets, but not the monopolistic distortions of markets that concentrated power created. The panic seemed to support both views. It showed that concentrated power, embodied in Morgan, could be beneficial during crisis. Morgan's intervention had prevented catastrophe, but it also showed the dangers of depending on private power, of having one man with such influence over the entire economy. And it showed that market discipline alone couldn't prevent the excessive speculation and risk-taking that had contributed to the crisis. In economic theory, the panic contributed to emerging critiques of classical economics. Economists began paying more attention to business cycles, to the psychological dimensions of economic behavior, to the role of credit and financial systems in causing instability. the notion that economies naturally tended toward equilibrium was increasingly questioned. If left alone, economies seemed to cycle between boom and bust, with each phase generating conditions for the next. Perhaps active management was needed to moderate these cycles. These theoretical developments would culminate decades later in the work of John Maynard Keynes, whose general theory of employment, interest, and money, published in 1936, would revolutionize economic thinking. Keynes argued that market economies could get stuck in underemployment equilibrium, situations where unemployment was high and would remain high without government intervention to stimulate demand. His ideas justified activist fiscal and monetary policy, giving theoretical support to practices that had been emerging more pragmatically through trial and error. But in the years immediately following 1907, these theoretical developments were just beginning. What was clearer was a shift in political culture, a growing acceptance that government had legitimate roles in managing the economy, in regulating financial institutions, in protecting citizens from market failures. This shift wasn't complete or uncontested. Debates about the proper scope of government involvement in economic life would continue throughout the 20th century and into the 21st. But the panic had moved the terms of debate, making positions that had seemed radical before seem more reasonable. The trust company industry itself underwent transformation in the wake of the panic. Before 1907, trust companies had been lightly regulated, able to engage in activities forbidden to banks, competitive and aggressive. After the panic, regulation increased. Trust companies came under stricter oversight, had to maintain higher reserves, were limited in their ability to speculate with depositor funds. Many trust companies merged with banks or converted to bank charters. The industry that had been so dynamic in the early 1900s became more conservative, more constrained, more similar to traditional banking. This regulatory response illustrated a pattern that would repeat throughout financial history. A period of a light regulation allows innovation and risk-taking. Some institutions profit enormously, others fail spectacularly. A crisis occurs, regulation is tightened, the industry becomes more stable, but also less dynamic. Over time, as memory of the crisis fades, pressure builds to loosen regulations again, to allow more innovation and competition. The cycle repeats. Understanding this pattern helps explain why financial regulation is never permanently settled, why debates about the proper balance between stability and dynamism continue. The panic also influenced thinking about corporate governance and the responsibilities of financial institutions. Before 1907, corporations were understood primarily as private entities whose responsibilities ran to shareholders and perhaps to creditors. The broader public interest was thought to be served automatically through competitive markets. Companies pursuing private profit would collectively produce public benefit. But the panic revealed that the failure of private institutions could have enormous public consequences. When banks failed, not just shareholders but depositors lost money. When trust companies collapsed, not just investors but the entire financial system was threatened. This recognition led to evolving ideas about corporate responsibility. Perhaps institutions that performed quasi-public functions, like banks accepting deposits from ordinary citizens, should be subject to special obligations and oversight. Perhaps their managers should be held to higher standards. Perhaps there should be mechanisms, like deposit insurance or bankruptcy procedures, that protected public interests when private institutions failed. These ideas wouldn't be fully implemented until the 1930s, but their seeds were planted in the debates following 1907. The relationship between finance and the real economy also received new attention. Before the panic, financial markets were often thought of as separate from the productive economy. Yes, they were connected, but finance was seen as merely facilitating real economic activity, not driving it. The panic showed how deeply interconnected they were. A crisis originating in stock market speculation could destroy trust companies which could cause bank failures, which could contract credit, which could shut down factories and farms. Finance wasn't separate from the real economy. It was integral to it. Understanding these linkages became increasingly important for both economic theory and policy. International dimensions of financial stability also came into focus. The 1907 panic had been primarily an American crisis, though it had some international effects. But World War I, which would begin in 1914, would demonstrate how internationally integrated financial systems had become. The war would disrupt trade, cause currency chaos, force countries off the gold standard, create massive debt flows. Managing these international financial relationships would require coordination among central banks and governments, would require thinking beyond national borders about how financial systems operated. The gold standard itself came under scrutiny. Though it would survive until the 1930s, the gold standard constrained monetary policy. Currency had to be backed by gold, which meant money supply couldn't be expanded beyond what gold reserves permitted. This prevented inflation, but also prevented monetary authorities from responding flexibly to crises. During the panic, the rigidity of the gold standard had made it harder to provide liquidity. Some economists began questioning whether the stability the gold standard provided was worth the constraints it imposed. These debates about monetary standards, about the role of government, about financial regulation, about corporate responsibility, all of these were fundamentally about power and who should wield it. Should private bankers like Morgan have the power to organize rescues and dictate terms? Should democratic governments have more power over finance and credit? Should power be distributed among regional interests rather than concentrated in New York? Should workers and farmers have more say in economic policy? The panic didn't resolve these questions, but it made them urgent, forced them onto the political agenda, created space for reforms that had been unthinkable before. Let these ideas and debates settle for a moment. Notice how a financial crisis, which began with stock speculation and bank runs, led to fundamental questions about how society should organize itself, about the relationship between economic freedom and government power, about whose interests should be prioritized when they conflict. The panic was about money and credit and liquidity, yes, but it was also about values and power and justice. The debates it generated continue to echo in our own time, whenever financial crisis strikes, whenever we face questions about whether to bail out failing institutions, about how to regulate markets, about how to balance stability with growth, protection with freedom. The specifics change, but the underlying tensions remain. The Panic of 1907 was one chapter in an ongoing conversation about how economies should work and who they should serve. While philosophers and economists debated theory and politicians argued over legislation, the Federal Reserve System had to actually begin functioning as an institution. The transition from concept to operating reality was neither smooth nor simple. Understanding how the Federal Reserve learned to perform its functions, how it struggled and adapted during its early years, reveals something important about the gap between institutional design and institutional practice. The Federal Reserve officially began operations on November 16, 1914. This timing was both fortunate and unfortunate. Fortunate because World War I, which had begun in Europe in August, created immediate challenges that tested the new system. Unfortunate because the Federal Reserve had to learn its role during extraordinary circumstances rather than having time to develop procedures during normal conditions. It was like learning to fly an airplane during a storm. The structure that Congress had created was complex and in some ways internally contradictory. 12 regional Federal Reserve banks were established in different cities: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. Each had a degree of autonomy, was owned by the commercial banks in its district, and was managed by a board of directors that included representatives of both banks and the broader business community. Overseeing these regional banks was the Federal Reserve Board in Washington, appointed by the President and confirmed by the Senate. The board was supposed to coordinate the system, establish policies, ensure that the regional banks work together rather than at cross purposes. But the relationship between the board and the regional banks wasn't clearly defined. How much autonomy did the regional banks have? Could they set their own interest rates, or did the board control that? Who had final authority when conflicts arose? These ambiguities reflected the political compromises that had been necessary to pass the Federal Reserve Act. Regional interests had wanted power distributed geographically. Banking interests had wanted operational control. Democratic politicians had wanted political accountability. The resulting structure tried to satisfy all these demands, but coherence was sacrificed to achievability. The system would have to figure out through practice how its various parts would work together. The Federal Reserve's most fundamental function was to serve as lender of last resort, providing liquidity to banks during crises. This was the function Morgan had performed in 1907, and it was supposed to prevent future panics by institutionalizing that role. But how exactly should it work? What terms should the Federal Reserve offer when lending to banks? What collateral should it accept? How should it distinguish between banks that were temporarily illiquid and banks that were genuinely insolvent? The tool the Federal Reserve was given for this function was the discount window. Commercial banks could borrow from their regional Federal Reserve Bank by presenting eligible paper, commercial loans, acceptances, certain securities as collateral. The Federal Reserve would advance funds against this collateral, charging an interest rate called the discount rate. Banks could use these funds to meet withdrawal demands or to maintain required reserves. When the loan came due, the bank would repay the Federal Reserve, reclaiming its collateral. Setting the discount rate was one of the Federal Reserve's most important policy decisions. A low discount rate made borrowing cheap, encouraging banks to borrow and then lend more freely to their customers, expanding credit. A high discount rate made borrowing expensive, discouraging it, contracting credit. The Federal Reserve could theoretically manage the economy by adjusting the discount rate, lowering it during recessions to stimulate activity, raising it during booms to prevent overheating. But this assumed the Federal Reserve knew when to raise rates and when to lower them, that it could diagnose economic conditions accurately and act at the right time with the right magnitude. In reality, the Federal Reserve had limited information, imperfect understanding of how its actions would affect the economy, and the challenge of coordinating 12 regional banks that might have different views on appropriate policy. The first major test came in 1920 and 1921. During World War I, the Federal Reserve had kept interest rates low to help finance the war effort. Credit expanded substantially. After the war ended in November 1918, inflation accelerated. Prices rose rapidly as wartime production shifted to consumer goods while money supply remained elevated. By early 1920, inflation was causing serious concern. Savers were losing purchasing power. Workers demanded wage increases. There was social and political pressure to do something. The Federal Reserve responded by raising the discount rate sharply in 1920, from 4.75% to 7% at some regional banks. This was intended to contract credit and slow inflation. It worked, perhaps too well. Credit contracted sharply. Businesses that had borrowed to expand found they couldn't roll over loans. Commodity prices, particularly agricultural prices, collapsed. The economy plunged into severe recession. Unemployment rose sharply. The recession was brief but intense, lasting from early 1920 into late 1921. The 1920-21 recession taught painful lessons about the power of monetary policy and the difficulty of calibrating it correctly. The Federal Reserve had succeeded in stopping inflation, but at enormous cost. Had it raised rates too high? Had it acted too aggressively? Should it have anticipated the recession and loosened policy sooner? These questions were debated intensely, but there were no clear answers. Monetary policy required making judgments about the future, based on incomplete information about the present. Even well-intentioned policymakers could make mistakes. The recession also revealed tensions within the Federal Reserve System. Different regional banks had favored different policies. The New York Federal Reserve Bank, led by Benjamin Strong, was the most powerful regional bank because New York was the financial center, and because Strong was exceptionally capable and ambitious. Strong had views about monetary policy that didn't always align with the Federal Reserve Board in Washington or with other regional banks. He believed the Federal Reserve should be more aggressive in using monetary policy to manage the economy, while others preferred a more passive approach. Benjamin Strong deserves attention because he was the most influential figure in the Federal Reserve during its first decade. Strong had been a successful banker in New York before being recruited to lead the New York Federal Reserve Bank. He understood finance deeply, had worked closely with Morgan during the 1907 panic, and brought to the Federal Reserve both technical expertise and a willingness to act decisively. He believed the Federal Reserve should be activist, should use its powers to smooth business cycles, should coordinate internationally with other central banks. Strong's activism wasn't universally welcomed. Some Federal Reserve Board members in Washington resented his influence and independence. Some other regional bank presidents thought New York was dominating the system. There were genuine policy disagreements about how activist the Federal Reserve should be, but these were often intertwined with personal rivalries and institutional jealousies. The Federal Reserve was learning not just technical questions about monetary policy, but also how to function as an organization with multiple power centers and competing agendas. The 1920s, after the harsh recession of 2021, were generally prosperous. The economy grew vigorously. Stock prices rose. Credit was abundant. The Federal Reserve faced the challenge of managing a boom. Should it restrain credit growth to prevent excessive speculation? Should it allow prosperity to continue, accepting the risk of eventual correction? Different people within the Federal Reserve had different views, and the system as a whole had difficulty arriving at coherent policy. Strong favored a relatively accommodative policy during the mid-1920s. He believed the economy had room to grow, that prosperity was sustainable if not excessive. He also worried about international considerations. European economies were struggling to recover from World War I. An overly tight American monetary policy might hurt them by attracting capital from Europe to America. Strong thought the Federal Reserve should consider these international effects, should coordinate with European central banks, should act as a responsible member of the international financial community. Other Federal Reserve officials were more concerned about stock market speculation. By the late 1920s, stock prices had risen dramatically. More and more people were buying stocks on margin, borrowing money to purchase securities. This looked suspiciously like the speculation that had preceded the 1907 panic. Some Federal Reserve officials wanted to raise interest rates to restrain speculation, to prevent a bubble that would eventually burst. But raising interest rates had drawbacks. It would slow the entire economy, not just stock speculation. It might cause recession. Was it the Federal Reserve's job to prevent speculation, or just to maintain overall economic stability? If people wanted to speculate, was that their business? These questions didn't have obvious answers, and the Federal Reserve was divided. Benjamin Strong died in 1928, removing the most forceful personality from Federal Reserve leadership. His death came at a critical time, just as decisions about how to respond to stock market speculation were becoming urgent. Without Strong's leadership, the Federal Reserve System became more fractious, less able to coordinate policy, more subject to conflicting pressures. In 1929, the stock market crashed in October, beginning the Great Depression. The Federal Reserve's response to the crash and to the banking crises that followed has been debated by historians and economists ever since. Why didn't the Federal Reserve prevent the crash? Why didn't it do more to stop the banking panics of the early 1930s? Why did it allow the money supply to contract so severely during the Depression? The answers are complex. Partly the Federal Reserve still thought in gold standard terms. It was constrained by the need to maintain gold backing for currency, which limited how much it could expand money supply. Partly there were continuing disagreements within the system about appropriate policy. Partly the Federal Reserve didn't fully understand what was happening or what needed to be done. Partly political pressures and fears about inflation made aggressive action difficult. The Federal Reserve had been created to prevent panics, but when the biggest panic in American history occurred, the Federal Reserve failed to prevent it or to respond adequately. This failure would lead to additional reforms in the 1930s. The Banking Act of 1935 restructured the Federal Reserve, giving more power to the board in Washington relative to the regional banks, centralizing authority, trying to make the system more capable of coordinated action. Federal Deposit Insurance was created in 1933, removing one major source of bank panics by guaranteeing depositor funds. These reforms represented recognition that the Federal Reserve as initially designed had been inadequate. But we're getting ahead of ourselves again. In the years between its creation in 1913 and the Great Depression in the 1930s, the Federal Reserve was learning through experience, through trial and error, through success and failure. It was figuring out how to perform functions that had never been institutionalized before in America, how to coordinate a complex system with multiple centers of power, how to make technical judgments with huge economic consequences. The story of the Federal Reserve's early years illustrates something important about institutional development. Creating an institution legally is relatively straightforward. Congress passes a law, the president signs it, the institution exists. But creating an institution in practice, developing the knowledge and procedures and culture that make it effective, takes much longer. The Federal Reserve existed on paper in 1913, but it took decades for it to truly become the institution it was meant to be. This pattern isn't unique to the Federal Reserve. Most major institutions go through similar developmental processes. They're created in response to specific problems, with specific functions in mind, but the problems evolve. New challenges emerge. The institution has to adapt. What works in one context might not work in another. Learning takes time and often comes through painful experience. The Panic of 1907 had revealed the need for a lender of last resort. The Federal Reserve was created to fill that need. But being a lender of last resort turned out to be more complicated than simply making loans during panics. It required judgment about which institutions to support and which to let fail. It required understanding complex financial systems and how disturbances propagate through them. It required coordination among multiple actors with different interests. It required balancing multiple goals that sometimes conflicted: stability versus growth, domestic concerns versus international responsibilities, short-term pain versus long-term sustainability. The people making these judgments were intelligent and capable, but they were human. They had incomplete information. They disagreed among themselves. They made mistakes. Sometimes they acted too slowly or too timidly. Sometimes they acted too aggressively. The Federal Reserve wasn't a perfect solution to financial instability. It was an imperfect institution staffed by imperfect people, trying to perform difficult tasks under uncertain conditions. This doesn't mean the Federal Reserve was a failure or that creating it was a mistake. It means that institutional solutions to complex problems are never complete or final. They're always works in progress, always requiring adjustment and improvement, always falling short of ideal performance. Understanding this helps us appreciate both what institutions can accomplish and what their limitations are. It helps us maintain realistic expectations, not cynicism that dismisses institutions as worthless, but also not naive faith that institutions will solve all problems automatically. The legacy of the Panic of 1907 wasn't just the Federal Reserve itself, but the recognition that financial stability requires institutional infrastructure, that markets alone can't provide it, that public authority has legitimate roles in economic management. This recognition was contested then and remains contested now. Every financial crisis revives debates about the proper role of central banks, about whether they should intervene aggressively or let markets correct themselves, about whether their power is too great or too constrained. These debates are valuable. They represent democratic deliberation about important questions. But they shouldn't obscure the fundamental insight that the panic provided, that modern financial systems are inherently unstable without institutional supports, that panics can destroy sound institutions along with unsound ones, that the human cost of financial collapse is too high to be accepted as natural or inevitable. The Federal Reserve, for all its imperfections, represented an attempt to act on that insight, to create mechanisms for preventing and managing financial crises. The attempt has been partially successful and partially unsuccessful, as most ambitious institutional projects are. Let these reflections rest for a moment. Picture the Federal Reserve in its early years, trying to figure out what it was supposed to be, how to perform functions that had never been institutionalized before, learning from mistakes, adapting to circumstances. Picture the people involved, board members and bank presidents, economists and politicians, all grappling with questions that had no clear answers. Picture the ongoing tension between the ideal of what the Federal Reserve should be and the reality of what it actually was. This tension between aspiration and achievement characterizes not just the Federal Reserve, but most human institutions. We create structures to solve problems, but the structures themselves create new problems, require ongoing attention and reform, never quite live up to their promise, but also accomplish more than their critics acknowledge. As we move toward the end of our journey through the panic of 1907 and its aftermath, let's consider what this crisis means in the longer sweep of financial history. Because 1907 wasn't the first banking panic America experienced, and it certainly wasn't the last. Understanding how it fits into a broader pattern helps us see both what's specific to that moment and what's universal about financial crises. America experienced banking panics with disturbing regularity in the 19th and early 20th centuries. There was a panic in 1819, another in 1837, a severe one in 1857. The Panic of 1873 triggered a depression that lasted for years. 1893 brought another major panic and depression, and then 1907. Each had specific causes: speculation in land, railroad overbuilding, international shocks, agricultural problems. But they all shared common patterns. The pattern typically began with a period of expansion and optimism. Credit was easy. Asset prices rose. New ventures proliferated. People borrowed to invest or speculate, confident that prosperity would continue. This expansion phase could last years, and as it continued, lending standards often relaxed. Banks extended credit to riskier borrowers. Leverage increased throughout the financial system. The boom created its own justification. Prices were rising, so buying at current prices seemed rational, even if those prices were disconnected from underlying values. Then something would trigger doubt. Perhaps a major firm would fail. Perhaps commodity prices would fall unexpectedly. Perhaps foreign investors would withdraw capital. The specific trigger varied, but the effect was similar. Confidence began to erode. As confidence weakened, people wanted to reduce their exposure to risk. Borrowers wanted to pay down debt. Lenders wanted to call in loans. Investors wanted to sell assets. But when everyone tries to reduce risk simultaneously, the collective action makes things worse. Selling assets drives prices down, which erodes confidence further, which causes more selling. Calling in loans forces borrowers to liquidate assets, adding to selling pressure. Banks face withdrawals and respond by reducing lending, which contracts credit, which hurts businesses, which causes more failures. The boom's self-reinforcing optimism gives way to bust self-reinforcing pessimism. Banking panic specifically occurred when this loss of confidence focused on banks themselves. Depositors, worried about whether their banks were sound, would rush to withdraw funds. Banks, unable to immediately convert all their assets to cash, would fail even if fundamentally solvent. Each failure increased fear, leading to runs on other banks. The panic would spread until something stopped it, either exhaustion, as everyone who wanted to withdraw had done so, or intervention, as in 1907 when Morgan organised support. This pattern repeated so regularly that economists developed a name for it: the business cycle. Economies seem to naturally fluctuate between expansion and contraction, boom and bust. The question was whether anything could or should be done to moderate these cycles. Classical economic theory suggested that intervention would only make things worse, that allowing markets to clear through price adjustments was the best approach. But the human cost of allowing markets to clear through failure and unemployment was immense. The creation of the Federal Reserve represented a bet that activist management could moderate business cycles without causing worse problems. By providing liquidity during contractions and restraining credit during expansions, the Federal Reserve might dampen the amplitude of fluctuations, creating more stable growth. Whether this would work was an open question in 1913. The experience of the following decades would provide some answers. Comparing the panic of 1907 to earlier panics reveals both similarities and differences. The similar features included the role of speculation. In 1907 it was copper and trust company stocks. In earlier panics, it had been railroads or land or commodities. The similar features included the cascade of failures, one institution's collapse triggering others in a chain reaction. The similar features included the human suffering, unemployment, poverty, dashed hopes. The different features included the central role of one individual in orchestrating the rescue. In earlier panics, no single person had the power and resources that Morgan wielded in 1907. The different features included the complexity and interconnection of the financial system. By 1907, America's financial markets were more developed, more integrated, more capable of transmitting shocks rapidly across the entire economy. The different features included the political response. Earlier panics had led to reforms, but none as consequential as the creation of the Federal Reserve. Looking forward from 1907, we can trace how financial crises continue to occur despite the Federal Reserve's existence. The Great Depression of the 1930s was far worse than the 1907 panic. The savings and loan crisis of the 1980s caused widespread failures. The financial crisis of 2008 brought the global financial system close to collapse. Each of these crises had unique features, but they also had family resemblances to 1907. The 2008 crisis is particularly instructive to compare with 1907. Both involved excessive leverage and speculation. Both involved institutions taking on risks they didn't fully understand. Both involved complex financial instruments that spread risk through the system in opaque ways. In 1907 it was interbank lending and stock margin lending. In 2008 it was mortgage-backed securities and derivatives. Both involved the failure of major financial institutions that had been considered solid. Both required massive interventions to prevent complete collapse. But 2008 also revealed how much had changed since 1907. The Federal Reserve existed and acted aggressively, providing liquidity on an enormous scale. The federal government bailed out major institutions using taxpayer money to prevent failures. Deposit insurance meant there were no bank runs of the type that had plagued 1907. The institutional infrastructure created in response to past crises provided tools that weren't available in 1907. Yet the crisis still occurred. The 2008 experience demonstrated that even with a central bank, even with deposit insurance, even with extensive regulation, financial systems remain vulnerable to crisis. The vulnerabilities take different forms. In 1907 it was trust company runs. In 2008 it was the shadow banking system and mortgage securitization, but the underlying dynamics of leverage, speculation and panic persist. This raises a profound question. Can financial crises be prevented, or are they inherent to market economies? The optimistic view, held by many in the mid-20th century, was that proper regulation and monetary policy could prevent serious crises. The experience of the Great Moderation, from roughly the mid-1980s through 2007, seemed to support this optimism. Business cycles appeared to have been tamed. Recessions were shorter and milder. Some economists declared that macroeconomic management had achieved such sophistication that major crises were unlikely. The 2008 crisis shattered this confidence. Just as the Great Depression had shattered confidence in the banking reforms of the 1920s. Perhaps financial crises can't be prevented, only managed. Perhaps the stability that regulation creates eventually undermines itself, as people take greater risks when they feel protected. Perhaps new forms of risk emerge that regulators don't anticipate. Perhaps the very size and complexity of modern financial systems makes them inherently fragile. These are questions without definitive answers. But the history of recurring crises, of which 1907 is one chapter, suggests humility is appropriate. Systems that seem stable can become unstable. Institutions that work well in one context can fail in another. Risks that seem contained can metastasize in unexpected ways. Financial history doesn't repeat exactly, but it does rhyme, and the rhyme scheme includes periodic crises. What does the panic of 1907 teach us that remains relevant? Several lessons emerge. First, that confidence is fundamental to financial systems. Banks, markets, economies all depend on people believing they'll work. When confidence breaks, institutions that are fundamentally sound can fail simply because too many people doubt them simultaneously. This makes financial stability partly psychological, dependent on maintaining trust even when circumstances create reasons for doubt. Second, that interconnection creates vulnerability. The more institutions are tied together through lending, through common exposures, through psychological links, the more a problem in one place can spread everywhere. In 1907, the failure of institutions tied to the Heinze brothers spread to Knickerbocker Trust, which spread to other trust companies, which threatened banks. The system's integration made it efficient in normal times but fragile during stress. Third, that someone or something needs to be able to provide liquidity during crises. Individual institutions acting rationally to protect themselves collectively worsen the crisis. Only an entity thinking about the system as a whole, willing and able to provide liquidity even at risk to itself, can stop the cascade. In 1907, that entity was Morgan. After 1913, it was supposed to be the Federal Reserve. The specific form matters less than the function. Someone has to be able to lend freely during panics. Fourth, that preventing crises is preferable to managing them, but prevention is difficult. Restraining speculation and excessive risk-taking when times are good requires acting against the prevailing mood, telling people they can't do things they want to do, being unpopular. The benefits of prevention, crises that don't happen, are invisible and easily dismissed. The costs of prevention, slower growth, constrained lending, are visible and politically unpopular. This creates a bias toward allowing booms to continue until they inevitably bust. Fifth, that crises have distributional consequences. They don't affect everyone equally. In 1907, as in every financial crisis, those with least resources suffered most. Those with wealth and connections could protect themselves, weather the storm, even profit from distress. Those without wealth or connections lost savings, lost jobs, saw opportunities disappear. Financial crises exacerbate inequality unless deliberate efforts are made to protect the vulnerable. Sixth, that reform after crisis is possible but difficult. The panic of 1907 led to the Federal Reserve, a significant institutional innovation, but it took 6 years of political struggle, required compromise among competing interests, and produced an imperfect hybrid structure. Reform requires energy that crises initially provide but that dissipates as memory fades and opposition organizes. The window for significant change is often brief. These lessons are depressing in some ways. They suggest that despite our best efforts, despite institutions and regulations, despite accumulated knowledge about how financial systems work, crises will continue to occur. We can moderate their severity, manage them more effectively, reduce their human cost, but we probably can't eliminate them entirely. This isn't because we lack knowledge or goodwill, but because the features that make crises possible — leverage, speculation, interconnection, the psychology of booms and panics — are integral to how modern financial systems operate. But the lessons also suggest possibilities for improvement. Each crisis teaches something. Each reform, even if imperfect, makes the system somewhat more resilient. The 1907 crisis was shorter and less severe than it might have been because of Morgan's intervention. Later crises were more effectively managed because of institutions created in response to earlier ones. Progress isn't linear. New vulnerabilities emerge even as old ones are addressed. But there is learning, adaptation, slow improvement. The story of the panic of 1907 is in many ways the story of finance itself. Moments of panic and failure interspersed with longer periods of functioning and growth, human frailty and folly alongside human ingenuity and resilience, private interests shaping public outcomes, and the ongoing struggle to create institutions that serve society rather than just those who control capital. These tensions aren't resolved. They're managed, imperfectly, through institutions that are themselves imperfect, by people who are trying to do the right thing but don't always succeed. Understanding this history doesn't provide a blueprint for preventing future crises. It doesn't offer simple solutions or clear heroes and villains. What it offers is perspective. It shows that the challenges we face today in managing financial systems aren't new. It shows that the tension between stability and growth, between regulation and freedom, between private interests and public welfare, these have been constant features of market economies. It shows that both excessive faith and excessive cynicism about institutions are misplaced. Institutions can accomplish important things, but they can also fail. They require constant attention, reform, improvement. The panic of 1907 sits in this long history as a moment when the system came close to failing but didn't, when one person's intervention made a crucial difference, when the vulnerabilities were stark enough to force recognition and reform. It's a reminder that crises can be managed, that leadership matters, that institutions can be created to address problems. But it's also a reminder that crises happen, that their costs are real and distributed unequally, that the institutions we create are imperfect and require ongoing work to maintain and improve. Let these historical patterns and lessons settle gently. Notice how the specific details of 1907, the Copper Corner, Knickerbocker Trust, Morgan's Library, are products of their time, unique and unrepeatable. But notice also how the broader patterns, speculation, panic, the cascade of failures, the need for intervention, appear again and again across financial history. The surface changes, but the depths remain familiar. Understanding this helps us see both what's new about current challenges and what's timeless, what we can hope to change and what we must learn to manage. History doesn't provide answers, but it does provide context, and context is its own form of wisdom. As we approach the end of our journey through the panic of 1907, let's take a final moment to reflect on what this story means, not just historically, but humanly. Because beneath all the economics and politics and institutional development, this is ultimately a story about people facing crisis, about how societies respond when systems break down, about the choices individuals make when stakes are highest. Think about J.P. Morgan in those October and November weeks of 1907. He was 70 years old, wealthy beyond measure, with every reason to enjoy his remaining years in comfort. He could have observed the crisis from a distance, protected his own fortune, let others worry about the collapsing system. Instead, he worked nearly without rest, risking his reputation, and resources, making decisions that affected millions of people, bearing a weight that would have crushed most men. Why did he do it? The easy answer is self-interest. Morgan had enormous investments in the financial system. Its collapse would have hurt him financially, would have damaged businesses he controlled, would have destroyed the world that had made him powerful. There's truth in this. Morgan wasn't acting from pure altruism. His interests aligned with preventing catastrophe. But this explanation feels incomplete. Morgan could have protected his own position without taking on the entire rescue operation. He could have looked to his own affairs and let the broader system fend for itself. That he didn't suggest something more than narrow self-interest was operating. Perhaps it was a sense of responsibility that came with power. Morgan had wielded enormous influence for decades. He had organized industries, directed capital flows, made decisions that shape the American economy. With that power came, perhaps, an obligation to use it when crisis struck. Whether this obligation was self-imposed or socially expected, whether it derived from noblesse oblige or from recognition that his power depended on system stability, these questions can't be answered definitively. But Morgan acted as though he had responsibility, as though the system's survival partially depended on him, as though he couldn't simply walk away. Or perhaps it was pride and ego. Morgan had been the most powerful private citizen in America for years. To step aside during crisis, to admit the problem was beyond him, would have been humiliating. By taking charge of the rescue, he affirmed his power, demonstrated his indispensability, ensured that history would remember him as the man who saved the system. This too is part of the picture. Great actions rarely come from purely selfless motives. Human psychology is more complicated than simple dichotomies between selfishness and altruism. Most likely Morgan's motivations were mixed. Self-interest, responsibility, ego, all intertwined in ways that he himself probably couldn't have fully untangled. He did what he did because of who he was, because of the position he occupied, because circumstances demanded it, and he was capable of responding. Trying to reduce this to simple explanations misses the complexity of human motivation and action. The same complexity applies to other actors in the drama. The bankers who cooperated with Morgan, were they acting from civic duty or from fear of being excluded from Morgan's orbit? Both, probably, in different proportions for different individuals. The depositors who withdrew their money during runs, were they being rational or succumbing to panic? Again, both. Each person thought they were protecting themselves, and each was right to worry, but collectively their rational individual actions created irrational collective outcomes. Charles Barney, the Knickerbocker Trust president who resigned and later killed himself, what was he feeling in those final weeks? Shame at having failed? Anger at being made a scapegoat? Fear about his future? Despair at seeing his life's work destroyed? We can only imagine, but his suicide reminds us that financial crises, even when resolved at the systemic level, leave individual casualties whose suffering is real and permanent. The panic teaches us something about the gap between individual rationality and collective welfare. Each depositor withdrawing money was acting rationally to protect their savings. Each bank calling in loans was acting rationally to maintain reserves. Each trust company refusing to lend to others was acting rationally to preserve its own capital. But these individually rational actions collectively created catastrophe. This is the fundamental problem that financial regulation and central banking try to address, creating mechanisms that align individual incentives with collective welfare, or overriding individual decisions when necessary to protect the system. But mechanisms and institutions are only as effective as the people operating them. The Federal Reserve's early struggles illustrate this. Having a central bank didn't automatically prevent crises or guarantee wise policy. It provided tools, but those tools had to be wielded by people with judgment, courage, and understanding. When the people were wise and courageous, as Benjamin Strong often was, the Federal Reserve performed well. When leadership was weak or divided or operating under incorrect theories, as during the early Great Depression, the Federal Reserve failed despite having the institutional capacity to succeed. This suggests that institutional design matters but isn't everything. Character matters, judgment matters, the quality of people in positions of responsibility matters. We can create structures that make wise action easier and foolish action harder, but we can't eliminate the human element. Financial systems, like all complex social systems, ultimately depend on the decisions of individuals who must act under uncertainty, with incomplete information, under pressure, with imperfect understanding of consequences. The panic also reveals something about social trust and its fragility. Financial systems, perhaps more than any other social system, depend on trust. Banks trust that borrowers will repay. Depositors trust that banks are sound. Businesses trust that credit will be available. Investors trust that markets are reasonably fair. When this web of trust is intact, the system functions smoothly. Money flows, commerce occurs. People can plan for the future with reasonable confidence, but trust, once broken, is difficult to restore. A depositor who has seen their bank fail, who has lost savings they had trusted to an institution that seemed solid, will never trust quite as completely again. A farmer who couldn't get credit during the panic's aftermath, who watched their farm be foreclosed while banks hoarded reserves, will view banks with suspicion forever after. The generation that lived through the panic carried that wariness for the rest of their lives, and they transmitted it to their children. Trust is built slowly and destroyed quickly, and its destruction has costs that persist long after the immediate crisis has passed. Yet humans have remarkable capacity to rebuild, to restore, to move forward even after experiencing crisis and loss. The financial system did recover from the panic. Trust was gradually rebuilt. Banks resumed lending, depositors returned, commerce normalized, the recession ended, life went on. This resilience is as important to understand as the vulnerability that makes crises possible. Yes, systems can break down catastrophically, but they can also be repaired. People can learn from mistakes. Institutions can be reformed. Progress, however halting and imperfect, is possible. The story of the Panic of 1907 is ultimately a story about navigation through crisis, about how individuals and institutions respond when confronted with breakdown, about the choices made under pressure, about learning from failure. It's a story that has been repeated many times in financial history and will be repeated again. The specific details change, but the core dynamics remain recognizable. Human nature doesn't change. The psychology of booms and panics, the tension between individual interest and collective welfare, the difficulty of building and maintaining institutions, the importance and fragility of trust, these are constants. If there's wisdom to take from this story, it might be this, that vigilance is necessary but never sufficient. We can build institutions like the Federal Reserve, we can create regulations to prevent excessive risk-taking, we can study history to understand patterns, but none of this guarantees safety. Crises will still occur because the conditions that create them, leverage, speculation, the eternal human oscillation between fear and greed, are integral to how market economies function. We can moderate, we can manage, we can respond more effectively, but we probably can't prevent entirely. This isn't cause for despair, but for realism. Understanding that systems are fragile helps us appreciate when they work well. Understanding that crises recur helps us prepare for them rather than being shocked when they happen. Understanding that institutions are imperfect helps us commit to their ongoing reform and improvement, rather than becoming disillusioned when they fall short of ideals. The panic also reminds us that economic systems exist to serve human flourishing, not the other way around. When the system failed in 1907, real people suffered. They lost savings, lost jobs, lost homes, lost hope. The suffering wasn't evenly distributed. Those with least bore the greatest burden. This is both a moral failure and a practical problem. because systems that distribute suffering so unequally undermine their own legitimacy. People eventually stop supporting systems that repeatedly fail them, stop trusting institutions that don't protect them. Creating economic arrangements that provide both dynamism and security, that allow for innovation and risk-taking while also protecting people from catastrophic loss. That balance efficiency with stability, this has been the great challenge of modern capitalism. The Panic of 1907 was one moment in the ongoing attempt to meet that challenge. The Federal Reserve was one institutional innovation aimed at achieving better balance. Neither the challenge nor the innovation was final. Both continue to evolve, require attention, demand our best thinking and efforts. There's something almost timeless about watching Morgan in his library. Making decisions with incomplete information, trying to determine which institutions could be saved and which had to fail, assembling resources, persuading reluctant bankers to cooperate, bearing the weight of an entire financial system's survival. It's a scene that could be translated to different eras. Central bankers in 2008 making similar decisions about which institutions were too big to fail. Finance ministers during the European debt crisis determining which countries to support. Treasury officials during any number of crises performing the same essential function of trying to prevent cascade failures while preserving some discipline against moral hazard. The tools change, the scale changes, the specific institutions change. But the fundamental human drama remains constant. People in positions of responsibility trying to prevent catastrophe, making difficult choices with imperfect information, acting under enormous pressure, knowing that whatever they decide, someone will suffer and someone will benefit, and history will judge whether they acted wisely or foolishly. These are the moments that test character, that reveal what individuals are capable of, that determine whether leadership is equal to the challenges it faces. Looking back at the Panic of 1907 from the vantage point of more than a century later, we can see both how much has changed and how much hasn't. We have institutions that didn't exist then. We have economic knowledge that has been accumulated through decades of study and experience. We have technologies that make coordination and response faster and more effective. These are genuine improvements, genuine progress. The financial system of the 21st century is in many ways more stable than that of 1907. But we still have financial crises. We still debate the same fundamental questions about regulation and freedom, about public versus private control, about how to balance competing values and interests. We still struggle with how to maintain stability without stifling dynamism, how to protect people without encouraging recklessness, how to create institutions that serve the public good rather than being captured by private interests. The progress we've made hasn't solved these problems. It's shifted their terms and given us better tools for managing them, but the problems themselves remain. Perhaps that's the most important lesson. There are no final solutions to the challenges of organizing complex economies. There's only ongoing work, building institutions, reforming them when they fail, learning from experience, adapting to new circumstances, balancing competing values, making difficult trade-offs, trying to do better than the previous generation while recognizing we'll leave unfinished work for the next. It's not inspiring in the way that stories of complete triumph are inspiring, but it has its own kind of dignity. It's the dignity of persistence, of continuing to try despite imperfection, of incremental improvement over time, of maintaining institutions and systems that, for all their flaws, make life better than it would be without them. The Panic of 1907 is part of this longer story. It was a moment of crisis that forced recognition of systemic vulnerability. It was responded to imperfectly but genuinely, with institutional innovation that addressed some problems while creating new ones. It was experienced differently by different people, causing suffering that was unevenly distributed and costs that were borne unequally. It taught lessons that were partially learned and partially forgotten, and must be relearned with each new crisis. It's a chapter in an ongoing story that has no final chapter, only continuation. And now, as our exploration of this crisis and its legacy draws to a close, Let all these threads settle gently. The specific events of October and November 1907. The personalities involved, Morgan, Barney, the depositors lining up outside trust companies, the workers who lost jobs, the farmers who lost farms, the institutions created in response, the Federal Reserve with all its complexity and contradictions, the ongoing patterns of boom and bust, of speculation and panic, of breakdown and recovery, the enduring questions about how society should organise their economic lives, about where the boundaries should lie between market and state, about how to create systems that serve human flourishing rather than just accumulating capital. Let it all rest. The crisis is long over. The people who lived through it have passed into history, but the lessons remain, the patterns persist, the challenges continue. We carry forward what they learned, build on the institutions they created, try to do better with the wisdom their experience provided. That's how human societies progress, not through perfect solutions, but through learning, adapting, building on what came before, leaving something useful for those who come after. The panic of 1907 is part of that ongoing human project, and understanding it helps us understand ourselves, our systems, our possibilities and limitations. Hold that understanding gently as you drift towards sleep, as this long story comes to its end and your rest begins. And so we've journeyed together through those autumn weeks of 1907, through crisis and resolution, through panic and recovery, through one man's extraordinary intervention and the institutions that emerged from that moment. We've walked slowly through the streets of old New York, sat in Morgan's library as decisions were made, stood with depositors outside failing banks, and traced how that crisis echoes through financial history to our own time. If you're still listening, that's wonderful. If you've drifted away, that's exactly what we're here for. Wherever you are in this story, in this night, know that you're part of something larger, the ongoing human story of building systems, facing crises, learning from failure, trying again with greater wisdom. The challenges Morgan faced aren't so different from challenges we face now. The resilience people showed then lives in us today. Let your breathing slow. Let the weight of history settle, not as burden, but as connection. You're linked to everyone who came before, everyone who struggled and survived and built something for those who followed. The panic is long over. The people have found their rest. Now it's your turn. Close your eyes if they're not already closed. Let the story fade like old photographs, like distant memory, like something that mattered once and still matters but no longer needs your attention. The details can blur. The lessons will remain, quietly, somewhere deeper than conscious thought. Sleep now. Let it all go. You're safe here. The past has released its grip. Tomorrow will come with its own concerns, but tonight belongs to rest, to peace, to the gentle darkness that holds all stories once they've been told. Sleep well. Dream of better days. Good night.